is now going after commodities. It's not just global trade. Now it's the commodities market. That's one of the biggest moves we've seen in like 50 or 60 years in copper. That's pretty crazy. I looked to see if it did anything on copper related instruments. Like I have some naked puts on FCX. I thought it'd be higher. It barely budged, but here's copper futures, one of the biggest single day moves ever, and also cleared of the 2024 highs. I don't think this is a good thing. In fact, I feel like this disruptive move is probably going to get faded. So I don't know. I mean, copper isn't everything, by the way. If you think that a tariff on copper is good, um, buy a car, buy a house, and see what this does. Like this is going to kind of instantly change things, and not for the better. I don't know what price does other than I want to stay out of copper. So it's been, if I was long copper back here when we had that first little flush out in April. I was long with like a 111 futures trade that paid out really well, but we're just continuing to go higher. Usually, the sign of copper is a good thing. Like, hey, copper's up. That's good for global growth. But this is such a distorted move that I don't think it's good. I think this potentially, if you go back on a weekly chart here, I've had this kind of channel high for quite a while. Like I think we just kind of ran right up to that measured move, and perhaps this is going to be kind of the top that gets put in on copper. Now it's still supported, right? I mean, it's still supported. We got some strong levels in here, but if we come back up and hit this high and fade off of that high, don't be surprised if we have a chance to, short copper. Maybe. I mean, again, if I short it, it's going to be defined risk. There's no reason to do anything silly like that. Okay, but pretty crazy stuff. So let's take a look at our commodities. Let's go to oil. Let's go to natural gas. Anything of substance happening here. Oil is hanging in off that 65 support. We're trading around 67.78 right now. And okay, I mean, do we hold 65? Are we in this new range where we're going to be from 65 to 75 again? Maybe. Natural gas. Natural gas is down to some fresh lows. I do have an expiration, I think, this week on my UNG positions that I need to continue to roll lower. UNG July 11th, which is going to be should be Friday. So I got a 17 call. I'll just keep kind of, I don't know. I don't really want to lower the strike, but at this point I might have to. I mean, my break even is in the 14s. So if I want to just get out of UNG, then I can. But I'm surprised this isn't making, I don't know. Like I'm hoping we kind of put in a low here, but we could also be pulling back to like freaking 1250. So my goal is just to, use the sell call side of my diagonal spread and just lower the cost basis. But if we base here around like 13 bucks and my break even is low enough, I might just let this thing pop. If it pops back up from like, $13 back to 17, 18, 19, 20, I don't really want to get in the way and cover that. Okay, gold, 3307, pretty flat for the day. Still leaning for a correction towards the 31 to 3000 zone, 3100, 3000 pullbacks towards my moving averages. Silver, I think this is a pretty good looking bull flag. Keep an eye on silver. If we hit fresh highs, I really do like silver a lot. Technically, I like it a lot more than gold right now. Bitcoin, just kind of squeaking by. 109 is still there. 112 is the highs. Yeah, I mean, if we get a breakout, great. I was kind of hoping we'd have a bit more of an efficiency pullback, which we kind of did. Pulled back to this 98,000 zone. I was kind of hoping we pull back to like 92-ish and give us a like a 50%. So if we have this low, this high, I was kind of looking for like that 50 to 61% zone. We didn't quite get there. And maybe we still do. Maybe this is going to be, still sideways and not really convincing. But if it ends up breaking highs, if we don't find this level and we end up breaking new highs, measured move is pushing towards like 130, which I think would be pretty exciting if you're just in Bitcoin and any exposure. Like that's more upside. Does Bitcoin go up, let's say 20% while the S&P does nothing? Maybe. We'll find out. What about the Nasdaq? Or do we have like the bigger global melt up? IBIT kind of right off those highs, FBTC right off those highs, MicroStrategy hanging out around 400 bucks. I've got a bull call spread on MicroStrategy up around 110% right now. But I ideally would like it to be like 400% because that was the initial trade. I need price to stay above 390, and if it does, then I'll make like 1,100 bucks out of a $300 risk. Coinbase, after that big surge on the stablecoin announcement, sideways. Actually, I think I might take a trade on Amazon today. We're trading at 223. I think Amazon has the potential to get back to 242. I'm going to look at a ratio spread here at the 160s. I know I have some more running on Amazon already. Amazon IV rank 28.2, not super high. Let me do an IV scan, but let me see first off, do I like? I know I have some Amazon exposure already. I have some expirations out to the end of the year. So 155 by 150. These are up about 53% right now. That's kind of exactly the level I want to play it at anyway. That's 160. Let's see. So these are December 19th. Maybe I go to the end of the year, put on a similar trade. I don't mind taking shares of Amazon. December 19th, I can go out to January. Look at this trade here. So 160. It's not a bad income trade. Also willing to own the shares of Amazon. Covered calls if I had to repair it. Going out 30 days, you can get anywhere between like $8 to $10 for an at the money. Yeah, I like this trade. I'm gonna start this off as an income trade. So if I own shares, I'd own the shares around 148.50. 148.50 would be below the April lows. So probability of profit is pretty high, about a 95% chance of profit. Chance of assignment is single digits, maybe about a 7% chance of assignment right now. Volatility currently is not great. I know we have earnings season coming on Amazon, but we have like Prime Day, which is happening now. I think Prime Day started for like the next 3 or 4 days. Love how it's Prime Day and now it's 4 days. But also logistically, it's like I think at some point Amazon warehouses will have nothing but robots. So this whole like future trade, AI trade, does Amazon get back up to all-time highs? I think it's possible that for one of the other Mag 7 stocks, this is proving to be, a steady contributor. So I like the trade. I'm going to take it. That's a 160 by 155 out to January for hopefully a buck. Let me see if I get $1.55 on the trade. So even if I get assigned, let me see, I've got enough cash in a lot of these accounts. I'll take the assignment. This one's fine. This one there. So all these accounts are going to get some love today on this one if I get filled for like 150 to 155. Let's try a 150. I'll try a 159. Okay, I'm trying to find a fill price first. It might be at the mid price. It might be slightly under the mid, but I'm going to try for at least a little generosity if I can get it. 56, 55. All right, so I'm filled at 55, which is the mid price. 155 is my fill. Okay, let me go through the list here. 9732. Really? The mid price is 157. Come on, man. 154. I tell you, some of these fills make me so mad to be filling below the mid price on a spread. All right, 153 is getting filled. Okay. So I'll get these all filled and then work my way into the Pulver alerts and get this one posted. All right, so trade is in. So this is Amazon. That is a January 16th expiration. Buying the 160 put, selling the 155 put. $1.53 credit. Willing to own shares. So the break even would be 155 assignment minus 5 minus $1.53. Oh, come on. 148.47. Okay, so break even 148.47. Okay, I'll post this into Pulver alerts. This will be under my stocks options. Okay, break even 147 if Amazon is less than 155 by expiration. We have about a 95% probability of profit, about a 7% chance of assignment. If assigned, I'll add covered calls to repair and look for $5 to $10 net profit on the repair. So that'd be $5 or $10 per share with owning 100 shares and make 500 to 1,000 bucks. Okay. All right, market's getting a little bit more directional and a little bit more dramatic this morning. Hopefully the levels hold. So I need price to stay out of this box, but also stay hopefully above this area. Maybe this goes for a 60, like a retest of 6,200 for going down on the day, but I was just choppy and messy before the FOMC minutes. We'll see. So keep an eye on that one. See if there's just noise. Let's go to currency strength. Super choppy in currencies this morning. Wow, like little to no movement whatsoever. Yesterday it was all Aussie with that surprise pause. Today just garbage. Nothing in Forex really happening. Okay, so this one is closed for profit. Profit, the 155 here is this is a January 116.26 expiration. Buy the 160 put, sell the 155 put, $1.53 credit. Okay, so that's going to get posted in Pulver alerts there. Okay. Apple. What's Apple's IV? Let me do a little IV scan here. So I'm going to go under high option volume. Anything crazy on the IV scans? High option volume. We'll go. Guess we'll go liquid. Some of these are not that great. Trying to sort through IV. All right. Any household names? QuantumScape, maybe a QuantumScape. QS. Never mind. Is this a quantum computing play? That's a big rip. Liquid symbols. Paramount Global. Teladoc. Maybe some Teladoc. Nope. All right. We do have some earnings coming up in the next couple of weeks. I did a filter on some earnings plays. If you can see this, let me try to make this a little bit larger. If you want to take a screenshot here, these are stocks that I'm interested in: Carvana, Roku, Roblox, Pinterest, ARM Holdings, SoFi. I think this is Decker's, DECK, is like the Hoka and UGG parent company. Tesla, Intel, and Robinhood. So I'm looking to put in some earnings plays here the next couple of weeks. July 30th, I mean, none of these have earnings this week. It's all coming in like financials lead next week. We have CPI, PPI. Once we lead with financial earnings, it's the big hitters, the big, hopefully the volatility kicks in the next couple of weeks. So I'm going to be looking at some positions on these. Try to find a different scan here. We got Brazil with the 32 IVR, not bad. Wouldn't mind selling some puts on EWZ actually. Up to 28 bucks. Could I go as low as 22? Probably not. End of the year. Yeah, there's just no premium. That's a bummer. Anyway, I'm long the shares EWZ and ILF. I own the shares. I've been kind of anticipating this bottom and moving to the buy zone, so they're both up a decent amount. Mags led mostly by Nvidia, Microsoft, Meta. Those have been the three top performers in Mag 7. AVGO isn't bad. It's not a Mag 7. It's a top 10. But I want to say that Nvidia, did it cross 4 trillion? It's creeping up on $4 trillion market caps. Oof. Earnings is out into August. So if you look at Mag 7 earnings, Apple earnings coming up fairly fast. This is going to be by the end of the month. Amazon earnings, also end of the month. Broadcom, we have earnings out into end of August. Google should have earnings end of the month. Meta, probably end of the month. Yep, end of the month. So the last week of July, I would say we got some fireworks with Mag 7 earnings. This one's a little bit earlier, July 29th. Netflix coming in. Netflix, I think, is next week. Yep, the 17th. Netflix has earnings 17th. NVIDIA out into August. Tesla has earnings, I think, in the 20s, 23rd. Polarizing Tesla. Berkshire. Are we sitting right at that 200-day moving average? What is going to happen to Berkshire Hathaway? Market clearly is treating it kind of like junk. S&P's up to all-time highs. Berkshire's not. I don't know why that's the case. Bonds today up a little bit, caught a bid. For the first time in 5 days, we're seeing the 10-year Treasury yields going slightly down on the day. I still think they're going to be sticky. I don't think the Fed cutting or not cutting. I don't know. I think this talk of rates going to 5+% on the 10-year, maybe it doesn't happen, but maybe we don't. I don't know. We might not see Liberation Day lows when the market was breaking essentially. But I don't know. This might just be like a really messy yield curve. But that's like the big question for the Fed this year is as they cut, are they cutting one, two, three times? The market's anticipating, I think, 4 to 5 or 6 cuts by the end of 2026. Do we start to see that the yields are going to also coordinate with a lower official cash rate? I don't know. The 20-year at 4.9, the 30-year at 4.9, like, that 5%, those are big levels way out there in the future. Right now, the U.S. is only issuing debt like at 9-month increments. They're not going anything longer term than that. So I think that's why the pressure is like cut, 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 because all we're really doing is we're trying to modify the short end of the curve. Futures wise, let's take a quick peek at futures just because copper with that big move has just done anything. Palladium not really doing much. Platinum, big move on platinum. I think this is a buy the dip. I mean, look at this as there's a low, there's a high. Try to find a nice little fib zone in here. I wouldn't mind getting some exposure to platinum. One way to do that is PPLT. So we're trading at 122. I think I'm just going to set a chart alarm on some of these fib levels and see if I can pull a trade. So maybe pull like a 30 to 50%. Dollar cost average and buy this thing at like 100, 105, $110. And I might just dollar cost average. So if I can buy right around here and it goes back up to the highs, that's a 20 to 30% run. But if I buy it here and also at the lows, so maybe do like I don't know, maybe $1,000 and then another $1,500. Put that in about a 1% stake, and that 1% can hopefully double or close to it. So if we get a halfway point, that's up around 35%. We'll see. So maybe a pending order around this like 107 area, 107, and then down to maybe 90 or 85, like at the lows. But this is at a nice surge. I'm just going to wait for some pullbacks. So let me see if I can get like a 107.50. 107.50 is just above the 50% zone. Find some equilibrium there. This is a commodity-based move. This is a commodity-based move. Oil kind of threw this whole thing for a loop. Liquidity is still pretty tight on J&K and LQD. Initial jobless claims, we talked about this, watching these trends. It's the continuing jobless claims that I'm watching closest. This is still sideways. I mean, I think that people are still able to go out and get jobs. That's the whole point. That's the whole argument. Like, we're not going into recession because people can still work and get jobs. I don't like where this is trending, however. Continuing jobless claims is trending higher. This is a bit of a sticking point. Our non-farm numbers, I mean, they argued that last non-farm payroll, even though the numbers beat, with the average hourly earnings down and the ADP down, that essentially it was like a net zero. But markets didn't seem to care because we had all-time highs again. China is still sideways. I mean, I still like buying some dips on China for some good like technical levels, just not chasing. I still have shares of Alibaba, which has been fading. Baidu had a nice little pop yesterday, but it's fading. FXI still hanging in there, looking to see if we hit these recent highs. KWeb, same thing. Look to see if we hit recent highs. JD is at 31.55. I'm just selling calls. Schwab dividend, Schwab growth, all at recent highs. Stocks above the 50-day, stocks above the 200-day. Nasdaq stocks above the 50-day, pretty high. Nasdaq stocks above the 200-day, pretty high. Costco, I hope Costco does a split. I mean, I like the stock. I've been in the stock for a while, just as a Costco member, but it's just too expensive. I can't really do a lot with options when I'm not interested in owning that much of a. Do I want to put $90,000 on it? No, I don't. Walmart, collar trade. Still can see if it gets called away at 100. Nike's done pretty well post bottom. So a lot of puts in, ratio spreads looking pretty good. Exposure levels be like 55. Unlikely to get assigned at 74. We'll keep an eye on this one. Home Depot and Lowe's still waiting for pullbacks. Let me check some home builders in a second. MasterCard, Visa. A lot of volatility here. They're fighting the good fight with the stablecoin news. Amex made a surge. It's funny how these have lagged. This ripped up to all-time highs, AXP took a while, and then just recently, like afterwards, it's like, Oh, MasterCard, Visa, you guys went up. We'll go up too. So it's like Amex did something later. Johnson & Johnson, I'm still long puts. Progressive is breaching the 200 moving average. What? What did I do on PGR? I've got a trade on PGR. I think it's in the 215 by 210 zone. PGR. I've got two separate ratio spreads here. The 220 by 210 out to September, and the 195 by 190 out to January. So net, I'm down about $14, but collectively this should be about $320 of income if we can stay above 210 and above 190 for these expirations. Expected move. I mean, if we have earnings, go out to September. I'm still outside the expected move by quite a bit. I mean, the probability of profit remains about 90% right now. And even into January, still outside the expected move. So that looks good mechanically. Just hopefully there's not too much drama happening below this 200-day moving average. This is an insurance play as well. Palantir. I'd like to keep an eye on this one. I want to buy some dips on Palantir. I've got some ratio spreads here. HIMS, big gap lower. I'm sure there's some aggressive traders that bought that dip immediately and they're up a few bucks. This might settle in. I've got some ratio spreads down here into the 30s. Carvana, impressive. I mean, it's just a used car company. And they're just ripping to the upside. Salesforce, O'Reilly, this one's split. Zillow's looking better. Uber, up to some fresh all-time highs. I've got some ratio spreads running there. Lyft, still owns some shares, trying to get Lyft to get some of this Uber love. I mean, come on, man. If Uber can get to all-time highs, why can't Lyft join the party? Let's get to 18, 19, 20 bucks. I'm not looking for anything crazy. We had a huge gap up here on Lyft. I'd love to see Lyft somehow get a surge into the 20s, and I'll take some profit. But I do own the shares, so it's actually a campaign trade in Pulver alerts. Sector-wise, got some mixed sectors today. XLP, which is consumer staples, down 0.74%. Energy, a little softer on the day. XLV, healthcare, a little softer on the day. Real estate, a little softer on the day. Everything else is green right now. Markets are sideways. We kind of gapped up. We're right back to where we started on the day. So we gapped up, came back down. We're still positive, showing plus 0.32% on the S&P, but a lot of that's just because of the gap higher. So we'll see what price ends up doing. So watching my levels. Do we get price back into the chop fest like this here going into FOMC this afternoon, or the not FOMC but the Fed minutes today at 2 p.m. All right, I've got a few more minutes. I've got a hard stop at the top of the hour at 11 o'clock. I've got some currencies. You want to post them? Yep, gold, sure. Silver, yes, we did those. We'll do them again. Gold, all I'm doing is waiting. I want to see gold pull back to this 144 200 moving average. It's 3,100 or 3,000. I'm interested in buying more gold. We are 440 bars, 450 bars now. It's like we have a large bar count since we've hit the 200-day moving average. I think it goes all the way back to October of 2023. So all the way back here, we stretched about 445 bars. So it's quite a bit. That was the type of bar count that there's a reason I was bearish going into this year, looking for some protection, looking for some corrections, and it worked out. So that was on the S&P, that was on the Nasdaq, that was on a bunch of Mag 7 stocks. It's a pretty good indicator when the market is kind of overstretched. So I know gold has caught a great bid this year, but once it peaked at like 35, it just kind of stopped. So I think everyone that's crazy bullish on gold, you just have to wait. You know, it's like if gold pulls back, it's a good opportunity to buy. If it pulls back, if it's a good opportunity to buy. I think they're great opportunities to buy, but we got to see a pullback first. Okay. All right, we're starting to get some light up levels to maybe 6,200. Are we going to fall today? We fallen 1% today? We'll see. All right, that's gold. Silver, like I said, I like silver a little bit better. Bull flag potential. If we break the highs above 37, I think we run up into the 40s. The exciting part about silver is if we get a nice little run into the 40s, I don't know why we'd stop. I think we start eyeing all-time highs on silver. That's a 2011 high and a 1980 high. That could be an exciting trade for a little, little poor man's gold that could go up 13 to 30%. I'd say that's exciting. If we get a dipper pullback to the 200 moving average, that's fine. Looking at it's been supportive, it's been supportive, it's been supportive. If we pull back to it again, we're using it as a chance to buy those dips and see if it just stays in a nice solid trend, right? I mean, this is a type of instrument where it might not have this like ballistic move to the upside. I kind of hope that it does because that makes it fun when you're long and it just rips up like $20. But if it's just going to be steady, where it's like every dip is bought, making higher highs, every dip is bought, I mean, you can participate. There's ways to generate income on silver related trades, debit spreads and credit spreads, right? Little puts. I mean, it's like if we get dips and pullbacks, you add puts, you add spreads, and you can generate the extra income while you hold a core position. Okay. All right. Currencies, like I said, not much happening in currency land. CAD is weakest today, barely. I mean, the vertical axis is 30 and 25 or 30 and 30. So not much happening, about 50, 60 pips of movement today, which is pretty tight. So, I mean, position wise, I'll just give the rundown before I go. I'm still long Aussie CAD. I'm still long Aussie Swiss. So I'm long Aussie New Zealand. I'm long. So we're finally starting to see this one move. This is good. I did add a position here around 107.75. I'm looking for the recent highs at 1170 or higher. I'd like to see 1170. That's target one, or get back to these like 1400 levels, target two. These black levels are where I'm going to add in more. I'm going to buy more, buy more, buy more if there's a pullback. Aussie dollar. Nothing right now. I mean, I think it's open space to the upside. I'd still like to see a dip or a pullback to buy. I think the dollar still remains somewhat bid off those overextended lows. CAD Swiss, I'm holding long. CAD yen, no trade. Swiss yen, I mean, at all-time highs again. I don't want to touch this thing. I hate this currency pair. Euro Aussie, no trade. Euro CAD, no trade. Euro Swiss, I'm still holding long. It's choppy. It's coming back into, I mean, there's some pretty strong support here on 9,200. Euro pound, surprisingly volatile for a currency pair that usually only moves like 30, 40 pips a day. It's been way more volatile with some of these big surges. But really strong support off this like 8,300 handle. So if we get a pullback, so if we go, up, down, maybe it's a wedge position, but I think that euro pound looks better to kind of hold these lows and then maybe push back up into, let's say 88 to 8,900. I can measure that move, probably get back into somewhere here as far as resistance goes. Euro yen. I mean, you had a chance to buy the lows. That's about the best trade I see. Other than that, is going higher. I'm showing some overbought conditions. Overbought conditions with divergence. But where would I look to sell this? Probably up at these highs. I mean, that's a really aggressive trend line to say, hey, it broke the trend line. I don't know. Wait for maybe this equal high to get tested. Maybe there's a price pattern there, and then you can sell it. But as always, be careful on the yen pairs. Euro New Zealand, no trade. You had a chance to buy equal lows. We talked about that a few weeks ago. Euro dollar. The dollar index hasn't made a hard turn yet, so the euro dollar has same thing. Like it's just kind of putting in a bit of a high here around 1,800. But if we get a topping pattern, let's say that we go, up, down, and then the market turns back around. Well, that topping pattern could be a good span, a good like short-term swing trade. If we pull back to like 1,200, that's a great profit in my opinion. If we get a short, and then I'm still looking at like maybe getting long, like long euro dollar. Okay. I literally just talked about gold. Pound Aussie, no trade. Pound CAD, no trade. Pound Swiss. Did not get to my 1350. If you're interested in a small position, maybe looking at buying the lows again, very small position, looking to see if we just play back into this range. Range trade, I still think the pocket at 1300, 1350 gets hit. It's just a waiting game. I mean, Swiss is down to 0% interest rates. There's still a positive swap there. It's just unfortunately the Swiss is still just a strong currency. and it has been for the last couple of years. It's been one of the strongest baskets for the last couple of years. And we'll see if that switches. We'll see if there's any type of like intervention. We'll see if there's, maybe they cut to negative interest rates. I have no idea. I hope that's not the case. I think that's silly if the world goes back to negative interest rates. Forget about swapping Forex if you're going to go to negative interest rates. Pound yen, just a slow, steady climb to the upside. Pound New Zealand had a chance to buy some equal lows at 2.22. Pound dollar still hasn't broken this trend line. This thing's up, 1,700 pips off the lows, still hasn't broken a trend line. New Zealand CAD, I'm still holding long. New Zealand Swiss, I'm still holding long, waiting for a chance to enter. I've got some pending orders at the lows. New Zealand yen, no trade. New Zealand dollar, waiting for a pullback. Dollar CAD. I hope this is not the turn on the dollar CAD. I'm hoping that dollar CAD can come down to this level before it turns, so it's just an easy support trade, as opposed to it, hits this level first, finds resistance, then it sells back off. But I'd still be looking to buy like 34, 33, 3200 area. There's really strong multi-year support there. So this to me is like a no trade zone in the dollar CAD. I'll just watch it, but I'd like to, watch those lows first. Dollar Swiss, we made some fresh lows. We see some oversold conditions. If the dollar pivots at all, flushes back up to like 100, 101, 102, then dollar Swiss hopefully makes a turn. I'm trying to get out of this one around like 87 to 8800. Dollar yen, no trade. Big trade on dollar yen would be watch this for a big pattern, big head and shoulders pattern that maybe the floor breaks at 140. And I don't care if this trade takes 12 months. If it sets up this way and starts to sell off, if you get a head start here, stop loss above, this thing could set up for like a 2,000 plus pip trade. But you got to be patient. Okay. Thoughts on futures? I mean, futures are selling off right now. We're probably back to flat on the day. Futures are up like 0.5%. ES is now 0.16. So I have a futures workspace here. There's my day, like kind of day trading vibe on futures. We rolled over around 10 o'clock. So we've been running up all morning. We started to roll over a little bit. 63.10 down about 20 points on ES. And rolled over here as well on NQ. This one from roughly 23.1, about 150 to 200 points on NQ. So just have some 5-minute Heikin-Ashi candles. If I'm trading futures in the morning or intraday trading, that's kind of what I'm watching. I mean, in the bigger picture, this is a 1-hour chart. Doesn't look like it's doing much of anything. It's just choppy. Zoom out. It's like we see some back and forth, lots of back and forth here. So some volatility. But for the day traders and the scalpers, it's nice to get a little flush. 20, 30 points on ES equates to maybe 100 to 200 points on NQ. It's good day trading. Okay. All right. I got about 1 minute before I have to go. And we did full currencies, gold, silver, Bitcoin, dollar index, some stocks, futures. Put in a fresh trade. It's in Pulver alerts right now for Amazon. Did a 116 expiration ratio spread, 160 by 155. Earnings season kicking off here in a couple weeks. Next week is financials. I'm not saying financials aren't important. They're just low beta stocks. It's just kind of more the guidance. And then after financials, then we get into Mag 7. You're going to have Tesla thrown out there. By the end of the month, you'll have all of your Mag 7 stocks reporting earnings. So should be a little more exciting. The big dramatic trade war deadline, the tariff deadline was today, but it got pushed. It's pushed out to August 1st, and apparently that's not going to be adjusted. We'll see. I think it probably should be adjusted unless we're going to see more drama like, hey, nobody lined up to do trade deals with the US. What's that mean for stocks? And that, think about that. August 1st is actually during the week. So we have July 31st, which we're going to have Mag 7 earnings that entire week, Tuesday, Wednesday, Thursday. So that's the 29th, 30th, 31st. And then we have the end of the month on the 31st, and we have a non-farm payroll probably on August 1st, which is also a trade war deadline. So I would imagine that by the end of this month, things are going to get a little bit more interesting, probably a bit more dramatic, and we'll see what that looks like. So anyway, I am curious on the day. I mean, are we going down 1% today? We're going to hit 62 and change. It's kind of some open space garbage right now. So it's through my floor. That's annoying. I kind of want to put in some, I don't know. We'll see. I'm just curious if it's going to be uh, a gap here that the market is filling and then it pops right back up and we kind of contain prices going into the FOMC minutes today. So we'll see what price action does. Hopefully we're not sliding. If we're sliding back to 6,200, I'd say it's vulnerable for a break this week. If we slide below 6,200, then I think we're vulnerable for a potential retracement, which I've been talking about. That's a 5-wave move, right? We have 1, 2, 3, 4, 5 looking for an ABC correction. I mean, to me, that's anywhere between 5 and 10% on the indexes. So if we're starting that case, then obviously some intraday price action to the downside. We'll see if it works. Hershey, worst performing the S&P. Wow, that's harsh. HSY. So the worst stock today is down 4.5%. That's as bad as it gets today. Why is chocolate down? Hershey's down 49% to the April lows. This is definitely a picker-upper if I get a price at COVID, a 120 strike. If we hit this chart alarm at 120, I'll probably put some Hershey on. Anyway, all right. Intraday price action. Let's see what happens. This is around a 15 delta low. If we come back in and kind of fill this gap and then work our way back into the midpoint of the day, that's fine. Let's see what happens. I'll keep an eye on my SPX trades and FOMC this afternoon, 2 p.m. All right, I'll let you go. Talk to you soon. Thanks. Bye.
We often get asked by our US viewers, how do you guys trade gold and indices on a regulated broker? To trade gold, indices, and more, we trade using Webull. And for US citizens watching now, for a limited time, you can get free stocks if you use our promo link that can be found in the description or dropped in the live chat right now. Webull is our top pick and personal choice when selecting a broker here in the United States for stocks, indices, and commodity trading specifically. Get your free stocks now by clicking the link and signing up using the instructions found there. Now, back to the show. All right, guys, welcome back. Hope you enjoyed listening to Chris. I know I always do. I think we have FOREX James coming up. James, whenever you're ready and you turn on your camera, we'll switch it over to you, but we're just going to bridge the gap. Looks like he is ready. So we're going to pass the show over to James. Actually, we can just bring him in here instead of running another break. And I'll just say hello to him, and then we can go from there. What's up, James? How are you?
Hey, how are you? Yeah, I'm good, thank you.
I'm good. Good to see you back on the show. And yeah, you know the drill here. We'll give off the show, everyone, to James for a little bit to go through what he's looking at in markets at this time. It's gearing up, as Chris was just talking about, to be an interesting kind of summer here with the deadlines to tariffs being extended, pushed back. Markets seem to be celebrating that for now, but I do wonder if they are underappreciating what could take place if you get some falling out between nations. I think one of my thoughts, James, and I'd love to hear yours too on this, is that, you know, the stock markets are hitting all-time highs. Everybody's kind of back to normal. But we still have a huge amount of uncertainty if these trade deals that Chris was just talking about don't go through. I think in some ways they're potentially being the market's underestimating how concerning those dynamics could be if things come back. I'm not short the market. I'm not bearish. I just think the interesting thing about volatility and market expectations is they can get overdone on terms of fear, and they can also get overdone in terms of everything is good now.
Yeah, no, I completely agree. I think we went through a period where, as far as I'm concerned, it was like max pain was priced in. I mean, we saw S&P, Nasdaq, Dow, DAX all just fall off a cliff, essentially. So I think we reached technically what was it, sort of roughly 20-25% drop across the board. So I think that, to be honest, in my view, is a little bit of an overreaction. And then, as you said, yes, I would agree that it seems like it's just completely corrected without a care in the world, because nothing's really changed. You know, we've had a couple of bits of news, but as Chris said, it's been delayed again till April the 1st. Oh, sorry, August the 1st now. So why, you know, from sort of a logical view, why would it drop 25%, then rally over 30% or roughly 30% with pretty much no real change?
Yeah.
It's odd. Investors always confuse me a little bit.
It's interesting too, because I want to show one chart before I toss the show over to you. You got the DAX open. Are you long the DAX, by the way?
No, so I'm building a new trading model based on probabilities and statistics. But I was, oh yeah, this is the chart. Yeah, I was looking to take DAX, but I just never actually pulled the trigger, which I'm a little bit annoyed about now in hindsight.
Yeah, I've got a DAX trade running, and I've missed it so many times, and I'm finally in a nice DAX trade. But anyways, I wanted to share this one last chart here before I leave the show with you. The reason I bring that up and is because I'm an options trader. I trade a lot of options, just like, you know, Chris Pulver. He does a lot of options. I also do a lot of options. And one thing that options traders love to spend a lot of time considering is implied volatility, the VIX, volatility in markets, etc. And what we've seen is when the market, you know, spikes in volatility, it is scary, but it's also in many ways a huge opportunity for a lot of people who like to sell options, like myself. Like, this is sort of an opportunity because everybody gets so expecting, everybody's expecting just massive moves in the market. And what we so often see in markets is that when everybody expects the markets to move like crazy, they have an amazing ability to not do that, right? So everybody thinks, oh, the market's going to crash 20% lower in the next few weeks, and then just when everybody's thinking that's going to happen, the market calms down and slowly grinds higher for the next few months. And we call that a volatility squeeze or a volatility crush in the options world. The reason I brought that up about, you know, kind of people getting euphoric or terrified is because over here, when you get a really high spike in the VIX, we would call that a market environment in which people are very scared, high levels of uncertainty, and the options market is pricing in a big future swing. And then you get opposite scenarios, which I personally think that we may have overshot the other direction now. And this is what markets do. You know, they get really scared and then they overshoot the other direction. So what we see now is below the 200-day moving average. The VIX here is, you know, trading in the 16s, which is suggesting a very little amount of future volatility. So just something to think about. I typically like to be contrarian with the VIX. So when it's getting really scared, I'm typically more optimistic, or not optimistic per se, but I like to take the other side oftentimes of what the market's expectation of volatility is. Right now, it's very low. I'm not short the market, but I'm definitely not adding a whole bunch of longs to indices and stocks because I think the market is under expecting volatility at this time, and that we could actually get some hiccups and some concerns and things. So anyways,
yeah,
leave you with the stream. Just wanted to share that thought with everybody following Chris Pulver and ahead of your segment here. So James, you're going to take over the show for now. Before I throw it over to you, everybody, if you are not already subscribed to James and you enjoy his commentary, make sure to do so. We'll drop the link in the chat to where you can find his YouTube content. James, you got it from here, man. I'll back out.
Thanks, Nick. See you later.
All right, see you, man.
So yeah, we'll lead on a little bit from that point about when. So as Nick said, just to quickly recap that. I actually don't have the VIX on here. Hold on. So when we have high VIX, Nick said he likes to be a little bit contrarian. And I think that thinking can be essentially printed over to a lot of different things. A great example is me at the moment with the dollar. I think the dollar short idea is overcrowded. I'm not saying it's wrong. It might not be wrong, but I think it's too crowded. It's like a room. You can only fit so many people in before that room breaks or before the walls break. So I'm thinking that we're going to have some sort of upside on the dollar before we might head lower, or things could change. We might have a really hot CPI print. Labor market might start pulling back even more, and then we might start seeing a change in trend, and then we might get rate cut expectations completely priced out. However, again, that's more long-term thinking, but the contrarian idea in the markets actually does work quite a lot of the time if you approach it properly. Obviously, if you see the VIX rising and you sell full margin here and then sell again here, full margin, you're obviously not going to do well. But if you can take calculated risks, so for example, if you were a VIX trader, or you traded some sort of anything to do with the VIX in this case, you could have taken very, very small short positions during this period, and it would have paid out very nicely. Obviously, that's a perfect world where you risk correctly and you position correctly, but that contrarian sort of style can work a lot of the time, apart from when you get to things like gold. The S&P, Nasdaq, those types of things can also be very difficult because obviously they essentially just go to the upside, whereas the VIX isn't quite the same. It's sort of interesting. It's like what's the right word for this? It's like a heartbeat monitor. It has almost like a baseline level. Then obviously we see the spikes, obviously the volatility coming into the markets. So essentially, what would, in theory, be a very profitable trading strategy is just sell VIX rallies. I'm not saying you should do that. I've never tested it. That's not something I do. But that's obviously just from observing from hindsight. Anyway. How does German 30 compare? Sorry, how does German 30 swings compare to US 30? I'm not sure what you mean by how do they compare. They both move up and down. I wouldn't say there really is any core difference other than the fact that they're different things. But when obviously you're trading it with whatever style you trade, it's just another market. Is there any platform where I can trade industries without KYC? I'm from Bangladesh. I'll be honest, if a broker is not asking for KYC, it's not worth going to them. The problem is when you get, well, you see a lot of these exchanges, brokers, platforms that will advertise, oh, we don't do KYC. It's open to everyone. That's a problem. In my history, a lot of services that don't ask for KYC in financial industries quite often are either scams or they're not around for very long. So you're going to lose money a lot of the time. I'm not saying it's guaranteed. Obviously, I'm sure there is maybe one or two out there that are good, but KYC, in my view, is just one of those signs of a broker that takes business seriously. I agree, DXY is definitely overcrowded. I mean, come on, guys, you really think dollar is going to keep going down? Yes, it's possible, rather unlikely. Yeah, that's pretty much my thinking as well, soccer boy. I like your name. I mean, I showed this yesterday. I've got quite a lot of time today, so I'm gonna go through these things slowly today. But yeah, the dollar's cycle, the whole history of the whole recent history of the dollar is screaming buy now. I'm not saying you should buy now. I'm just saying that's what I am getting at the moment. So we go, we've got the cycles on the dollar from its typical price action behavior, where we have expansion, contraction, and we always have some sort of period where we're either expanding into, when I say expanding, I mean price is going up. When I say contraction, price is going down. That's just wording for me. Now we're coming to this point of contraction where we're at the bottom of this massive trend line that's been established for over a decade. We've got historically low or historically large short positioning on COT. It's not, I don't think it's the biggest short position ever, but it's definitely the biggest within over a decade. We've had repo, which essentially just tells us that there's a liquidity problem within institutions, demand for dollars. I'm not going to go into that. It's not a huge deal, but it's something I wanted to keep in mind. And obviously then we've just got the natural drift of the dollar. We've also got the fact it's still safe haven currency. It's still the currency, like the currency. Regardless of if you like it or not, regardless of your political view, the dollar is king. And I know crypto bros might disagree with that, but what do you buy crypto with? Well, it's dollars. So So that's my view. I just think the dollar is, again, I'm not saying it can't go lower. I'm just saying right now, I think the easiest path for the dollar is one of two things. If we just have a pullback and then maybe break lower, obviously, depending on CPI. I'm very, very cautious around CPI coming next week. Until we get that data release, I'm not going to make any real decisions just yet. Or I think we might come slightly higher, double bottom, and then we have that trend change to the upside on the dollar. If you look at a lot of the recent lows, we often have this double bottom pattern, which is very sort of typical in markets. When we are going to have a reversal, we'll often have sort of these, whether it be double bottom, triple bottom, whatever, but it's not uncommon to have that sort of typical price action display itself. I've been in both the DAX and the Dow today. For me, they move pretty similar. Yeah, they do, Lee. I agree. They're pretty easy. So yesterday I mentioned I'm working, or actually early on the stream, I mentioned I'm working on a statistical model for the DAX. So I'm just going to show you some of the data I've collected. Obviously, I showed you this yesterday, but I've got some more results here from live testing. And just to clarify, when I say it's a live test, I'm not taking the trade. It's live testing, as in it's testing on live markets. So I'm not actually doing anything. I'm just doing the markups and seeing how it goes. So essentially what this strategy consists of is just the anchored VWAP, and it always starts from the new session. So if I'm trading London, I'll put the anchored VWAP at the start of London. If I'm trading New York, it will go from the start of New York. And this is derived from a guy called Trader Tom. I think he's actually pretty much a legend in the trading community at this point. I think everyone should know who Trader Tom is. He's done like 400% this year alone with pretty much just this, or a very similar strategy. So essentially, I'm just waiting for these breaks of the second 15-minute candle on either session, London or New York. Then I'm going long or short, depending on that break. Well, obviously, if it breaks down, then I'll go short. If it breaks up, then I'll go long. So I'm just logging all of these different factors, like what's the max potential loss that the individual trade could have given me, what's the max potential gain, MAE, MFE, what's the daily or previous daily high and low range, what was price relative to the VWAP, how long did price take to get to take profit or stop loss, and those types of things. So I'm trying to build something that is not reliant on macro, in terms of economics, something that's not reliant on any outside information. It's just me and some data points on statistics. So I've never done that before. It's a completely new field that I'm going into. So it might not work. This whole thing might just completely collapse next week if we don't have a continuation on the dollar. But sorry, not on the dollar, on the DAX. But we'll see. OT, yes, I'm still in my euro pound short, which has done nothing. So it's just been range bound really since pretty much since the start of July. It's just sideways. So there's nothing really to do on that. It's just a case of hold it, let me get paid in swaps, and then just wait for it to revert. New Zealand yen as well. Caught quite a nice entry here. I actually entered down on this on the low down here. So yeah, it's just a case of waiting really for the break of this previous highs, or these previous highs. Then I'll look to enter again or scale in and trail my initial stop. So yeah, that's pretty much it. I'm not really doing anything. Again, I'm very much just on pause, because anyone that watches me often will know that the dollar is like my thing. I love to trade dollar, whether it be euro dollar, pound dollar, gold. The dollar is just it's just my preference. But as I already said earlier, I just can't make a decision for a swing trade anyway. I can't make a decision on the dollar until I've got CPI, because CPI will tell me, is the dollar set for a reversal, or at least some sort of upside? Or was the labor data that we had earlier just a bit of a pause, and then CPI is going to come in and just continue to break down the dollar? So I just don't want to be caught on the wrong side of the dollar at the moment, because it's pivotal. My view at the moment, and I know I keep talking about the dollar, so I do apologize, but again, it's the main thing I'm watching. This could be a huge buying opportunity. So all I need is CPI to just confirm that idea, and there is nothing stopping me starting to take long positions on the dollar. And that way, even if there is turbulence, maybe the Fed will cut rates, either way, I'm positioned then for the next expansion point on the dollar. And again, if it breaks down, fine, but that's what I'm trying to avoid by waiting for CPI, at least. The dollar's current move up is only a corrective one, is shaping for a move down to 95, probably in the latter part of Q3 or early Q4, time will tell. Maybe. I mean, 95 is still within my sort of buying zone, so I don't care really if it comes down to 95. That's fine, as long as it doesn't break below 95 and come down towards 90. Then my bullish idea is still intact. The thing is, what is there to drive the dollar lower? In my view, there's not that much. Don't forget, the dollar has been front run pretty much all year. We had trade tensions, geopolitical tensions. We had traders expecting rate cuts, which didn't happen. They were expecting poor labor data that didn't happen. So I think the dollar is undervalued, and it's priced in too much negative data that just hasn't come. So remember, July, we were expecting rate cuts, which actually 23 a week ago. Yeah, but we were expecting rate cuts, which obviously have been pretty much completely priced out for July. September, we are still expecting rate cuts in terms of the majority or the probability. But again, if CPI comes in on target or hotter, that might start getting priced out as well. I'm just not, I just find it very hard to be super bearish at the moment unless we get some other catalyst, which might be tariffs, it might be a rate cut, it might be really bad CPI, but again, I'm just waiting and watching. Recently, I started just enter $1 trade at a time. Till I had decent understanding of Trump markets. Yeah, I mean, you can have a good understanding of Trump markets, but you can't have a good understanding of Trump because he makes. Actually, to be fair, it's calmed down recently. There was a point where markets would close, and then on Saturday night, Sunday night, there'd be a tweet or a Truth Social post, and you'd have to be like, "Oh God, I've still got a trade open. What am I going to do on market open?" So yeah, I mean, yeah, have fun. What was the US interest rate pre-COVID? It was quite low. Let me just double check exactly what it was for you. Let's have a little look together. I can't remember exactly what it was. 5 years. Yeah, it was quite low here. Oh wait, hold on, sorry, that was 10 years. But when did COVID actually kick in? Yeah, it's 2.5, give or take. I suppose it came in really 2020, didn't it? Yeah, it was around 2.5 to 1.75 exactly when, depending on when you want to say COVID started. Because I think COVID was around in 2019, wasn't it? But I don't think it became a big deal until 2020. I think that's when we had, the dreaded lockdowns. Yeah, very low. Did you guys see the letter that Trump sent to Powell? Let me see if I can find it. Give me 1 second. What was it called? Here we go. I found it. So this was a letter, or I think it was a letter that Trump sent to Powell. It says, Jerome, you are as usual. This was a while ago, by the way. Well, maybe I think it was 1 or 2 weeks ago. Jerome, you are late as usual. Oh, sorry, Jerome, you are as usual too late. You have cost the USA a fortune and continue to do so. You should lower the rate by a lot. Hundreds of billions of dollars being lost in. I'm not sure what that word says. I don't know what he says there. He says we should be here. So Trump wants interest rates to be back lower than pre-COVID, like 1.75 towards 0.25. So yeah, interesting. I'm sure Powell's having a great time. you could draw a trend line connecting the lows which have occurred every 3 to 4 years. What do you mean, Lee? What, an interest rates? Yeah, I thought so, OT. Yeah. Gold seems to have picked up. I was looking at this yesterday and I said there just wasn't anything, but we had a very brief look at this trend line. Still can't justify buying gold. I don't think it's on the edge finder. Let me just have a quick look. It wasn't yesterday. Filter neutral. No. So we've got Euro CAD, DAX, NAS, Euro Aussie. Euro Aussie long, I don't really like that idea after the RBA held rates. I'm not confident that, let's just take a look. Yeah, I'm not confident that would be a great one just yet on the dollar. Yeah, I mean, the thing is with trend lines, Lee, and this is why I don't really like them. I'll use them in situations like this where you've got a very obvious trend for a long period of time. But I think you can draw them way too easily. I think you can make them fit anywhere, really. And that, to me, isn't a strong thing, you know. I also think they're too discretional. So you might draw a trend line. I might draw a similar one, but they won't be the same, likely. I'm not saying they don't work. Obviously, you know, people like Tory Trades have made it work, but just for me, yeah, not my style. What was I going to do? Oh yeah, that was it. The RBA. Let's go back to that quickly. RBA holds rates at 3.85 despite cut expectations. Awaits July 30 CPI for August decision amid split board and cautious here. Okay. Oh, sorry, cautious tone. So they're currently neutral to hawkish. It's the ECB. What's their stance? They're dovish. ECB adopts wait-and-see stance, weighing rate cuts or stability. September meeting key for next steps. Okay. So it's tricky because a lot of the central banks are just wait and see. You know, we've got the RBA wait and see, the ECB is wait and see, the Fed is sort of wait and see, data dependent. So it's making it very tricky for me to find anything that's worth putting money on the line for, because again, anyone that watches me regularly, you'll see me focus quite a lot on interest rates and the central bank policy, because I like to identify as LGBT. Now, joking. I like to identify as interest rates trader, and that's pretty much it. Obviously, interest rates encapsulate labor market inflation, and it can allow me to basically move through the markets quite simply. Except now, because you know, what can I do if they're all wait and see? I've got to wait and see then. So yeah, it's tough. Pound Swiss, I was looking to go short, but it's kind of run away from the entry. The issue is, if it came now back up to entry, I don't think I would want to take this because that would be a trend change. So it would kind of put me off unless there was an overwhelming reason to still be a short seller here. But yeah, I'm not confident pound Swiss anymore, really. I'll leave the markups there just for now. It seems the dollar's doing okay so far today. Let's have a quick look. Dollars. Actually, it's quite flat today. Never mind. It's only up 0.11. What about the week? How much are we up to this week? 0.65. What about monthly? 0.87. So we're up almost 1% so far in July on the dollar, which isn't bad. Let me just put my area chart back on. I've decided that area charts are much better to look at higher time frames. I've always sort of switched between them, but I've decided that area charts are the way forwards. I think they're beautiful. Euro dollar is still screaming sell. Again, just looking at the crowded market, looking at the overextended price action, the target or the level at 1.2 is still a big concern for me. I think there is a chance that we do reach 1.2, but I think the only way we would see 1.2 get hit is either if the euro really picks up in terms of data, or if we see weak CPI and we do see those rate cuts getting priced in quite aggressively, or continue to get priced in quite aggressively. If we don't get that and we do get let's say on target or hotter CPI, I think Eurodollar is going to come down to at least 1.15, maybe 1.16. And then, that might allow for a long-term long position. I know institutions are still bullish on Eurodollar, actually, which did surprise me slightly, but who am I to argue with them? Usually the market's range bound pre-FOMC, but I guess the DAX does not care. Yeah, I mean, DAX doesn't have that much reason to care about FOMC, I guess, really. But yeah, we're not seeing really anything, which, as you said, is to be expected ahead of FOMC. Although I would expect it to be hawkish to neutral. But don't forget, it's, as far as I'm aware, it's not a live meeting, it's just a statement. But yeah, I wouldn't expect it to be overly market moving. It definitely could be, but I really don't think it would be. Normally they're a bit of a snooze fest. The real juice comes after the rate cut, and we often get the forward guidance. Okay, so let's just see what else is there going on. Let's go back here. So we already know DAX is very bullish. I mean, that market's run away from me, unfortunately, so I completely missed that one. Nasdaq's a little bit extended. Euro Australian, I'm not really a fan of that one, just from central bank stance. Nikkei, actually, I was meaning to ask Nick about this, or someone at A1, because we were talking about it in my Discord. And the put call ratio for the Nikkei is nuts, or it was nuts. I'm not sure if it still is. Where is it? I don't use the put to call ratio. Let's see. Here. So where's that? There. Oh, okay. Well, something happened. Let me have a look at the Nikkei chart. So that's just crazy. So when was this? When was peak fear? That was July the 7th. So yeah, nothing has happened. So what is this? Does anyone know? Because this isn't something I use. I don't use put to call that often. I also don't trade the Nikkei, so I'm not sure if the information here is a bug because it looks crazy, or if this is just the Nikkei being the Nikkei. I don't know if this is normal. I don't think it would be a bug because it's been like that since 20th of June. I know the A1 guys are always quite on it with the Edge Finder. And DAX, all the other markets seem okay. Well, yeah, the Russell's had a similar thing. I guess it's probably just the way it is. It's crazy. But I don't understand that. Yeah, I do not get it. World Trades, hello. Long time no see, indeed. I've been hiding. What else do we have? Let's look at oil, because oil's been interesting. So it's extreme greed. Yesterday, someone said that OPEC's increasing production. So if oil's rallying, maybe it would be an opportunity to sell. I don't think there is really an option here, is there? It's not getting any sort of reading, which is unfortunate because I think it would be quite nice to go short oil. But yeah, I don't have a reason to be able to justify it fully. Euro pound still getting a bullish reading, which I don't like. Swiss yen also. We might be getting a little bit of a mean reversion. I mean, it's way too early to say that. I mean, we've only had a couple of bearish H4 candles, but it's just so extended. It just looks ready to drop. But the thing is, I said that previously and I was completely wrong. So I'm very, very cautious about Swiss yen. I think it's definitely not my time to sit there or to short here. You saw Mufti go long euro pound. Let me have a look. Probably. I think I'm fairly sure the institution's been long euro pound for quite a while. Refinitiv short, so they've got an entry at 0.8637, a stop loss at 0.869, and a take profit at 0.8535. Then we've also got ANZ Research that is long on Euro Pound, stop loss at 0.85, entry at 0.8614, and a take profit at 0.895. That's it though. Seems MUFG's portfolio is quite flat at the minute, in terms of FX positions anyway. I'm just trying to see something. Morgan Stanley has got a buy limit on euro dollar. Their buy limit is at 1.16. Actually, let me mark this up. I'll keep an eye on this. So they have an entry at 1.165, profit level at 1.21, stop loss at 1.13. Yeah. That doesn't look very interesting, to be quite honest with you. It was a Morgan Stanley long position. So, yeah, I'm not a fan of it, I'll be honest. You see MUFG's contrarian signal. I don't know, MUFG for me is actually being quite accurate in their calls. You know who is interesting though? Credit Agricole. Their research is quite often perfect. They do really good. They win. I think they're top 3 on Bloomberg's ranking in terms of their quality of analysis. Euro dollar, they're top. Pound dollar, they're top, and then for something like dollar yen, I think they're second. But their trades are interesting because it's very. It's almost mean reverting, but they don't use mean reversion. They go off economics. They've got a model. But yeah, their trades just aren't that great, but their analysis is just so good. It's really weird. So it's like if you can take their research and apply your own trade behind it, I'm sure you'd be quite nice actually. But following them 1-to-1, you'd be up like 4% over the past year or something. Meaning of backtesting. Morgan, backtesting is where you would take an idea of a strategy and you would go back and you would test it and see how does it work through history. So you could say something like this, for example, if New York high reaches and rejects London's high, maybe you look to go short, and then you would go and test that over 500 different trades throughout history on DAX or whatever it is you're doing. And that way you can say, okay, well, this is historically proven to work, so there is not really any reason it shouldn't work going forwards unless you didn't trade or didn't test different market cycles and conditions. You long the DAX by VGK. Is that Vanguard? I'm not sure what exactly VGK is, but it sounds like a Vanguard thing. Yeah, I mean, being long DAX is good. Actually, you know what's interesting? My stock portfolio has outperformed quite significantly recently. Oh, sorry, quite outperformed my FX position significantly. So I've got a position here on North Dynasty Materials on NAC that's up 37%. Wait, hold on. Or 33% actually, just jumped down. I had one on BBI or BBAI that was like a 70% gain as well. So portfolios doing very nicely. But yeah, the FX has been pretty flat this year. I'm sitting pretty much break even actually. I was down quite significantly, but managed to bring it back. Then I went back to drawdown and I brought it back again. It's just an absolute mess. Speaking of which, I need to send Nick my Q2 report. Vanguard European ETF. Okay. Vanguard European ETF. Yeah. I used to be involved quite heavily with Vanguard. I used to have an account with. I've got a retirement account and I had an investment account. It was okay, but it just, yeah, I don't know. I've switched over. I've still got a pension account with Vanguard, just because that would be a bit of a hassle to try and move around. But yeah, I moved all of my active or investment positions over to a different platform. I just have more options. I think Vanguard's more. I think Vanguard's more aimed at like an average sort of 9 to 5 person that doesn't or isn't involved in trading. Because it's just easy. It's like you click and go. But I wanted to be able to do a bit more. Pound dollar reversal. Sorry guys, I'm kind of just yapping today. Like I said, I've got quite a while. I've still got like 40, 50 minutes left, so we can just sit and have a little chat. Pound dollar reversal. Let's see. It would make sense. So what I see, I mean, I'm not going to go into the dollar. I've spoken about the dollar quite a lot recently. So this is the monthly time frame. We've broken above this 200 EMA once since 2009, and this was very quickly rejected. I think this was probably, when did it break? March 2014, and then July 2014, it broke back below. And since then, it's not been able to break above. And right now, we are coming up to that point again where we typically have these reversal points. So just looking at the typical price movements, yes, maybe a reversal is due. Weekly time frame. Let's see. We don't really have this triple top just yet, so maybe that would be something to watch out for. But we do have a double top here, which is kind of weak, to be honest. The RSI is overbought slightly on the monthly and overbought on the weekly. The daily looks ready to pull back, to be honest with you, but whether it will pull through, I don't know. The H4, I think, also does look ready to drop. It just needs to break out of this zone here. Next stopping point would be at 1.341. So in my view, I would need to see price breakdown. Then I'd need to see these moving averages cross for that trend change, and then I'd be looking to sell on the pullback. Although the dollar, again, it's a little bit tricky right now to try and build a longer term thesis on, because I really think it's either going to completely change and it's going to start going to the upside, or I think we're just pausing, and then I think we're going to completely go down really towards 95, 90, which obviously isn't helpful. But I like the Fed, like Powell. I am data dependent. Copper. Yeah, I saw that, the 50% tariff on copper. Yeah, I mean, just like anything else, we often have aggressive upside followed by corrections. It's not new. That's just how markets work. But I think this would maybe be quite a nice factor to potentially go long on copper if you can have the pullback here. I don't trade copper. I don't really know what is going on behind the scenes of copper in terms of what's driving it right now. But just from my very amateur understanding of copper, I do think a possible long on the pullback would be quite nice. High gold go up? That's a very vague question, my friend. I'm not really sure what you mean by that. Do you mean, is gold going to go up? I don't think so. I think gold is stuck until CPI. We've got two trends here, one up, one down. The EMAs are flat, indicating no real trend that we can trade. The RSI is completely flat, and we are stuck within quite a large, granted, but this sort of range-bound movement. We're not doing anything here. As soon as we start coming low, we bounce up. As soon as we start coming higher, we bounce back down. There isn't anything I can view here. The rate cutting idea, I'm not really in favor of because, you know, rate cuts are going to happen in July. Oh no, wait, no, they're not. Rate cuts going to happen in September. Well, I'm also not confident of that idea just yet either. So yeah, I don't know. Gold's tricky. Well, actually, I'm saying that I wouldn't want to sell gold either, just because obviously, I mean, look at the rocket that it's been on over the past, what, 2 years, 2 years. So yeah, trying to sell that, not my style, but I also can't justify being long just here. Good argument for GU long. There is, but there's also an argument for everything. So my idea, why is pound dollar gone? My idea with these dollar crosses, specifically pound dollar, euro dollar, would be, as I said, I think the next, as long as we can, actually, let me just pull up my pen. As long as we can break this sort of level around here, next stopping point would be this low. So around, let's just, for ease, let's call it 1.34. Then I might then I might start looking to go long, just like euro dollar. I think euro dollar is set to go down to around 1.16, 1.15. At that point, maybe I want to be a buyer. I'd have to review it, obviously, but I just think the markets are too crowded, they're too extended. Some sort of pullback is bound to happen. Whether it's going to happen tomorrow, next week, I don't know. But yeah, I just don't want to be a buyer of these dollar crosses. I mean, look, I've already missed all of this to the upside. Do I want to be the guy trying to buy right now here? No, not really. I think that would be more just playing on FOMO and greed rather than it being a calculated trade. So that's my view at the moment. Let's see. Where's my edge finder gone? Great ideas. Oh, I've never seen this before. Maybe it's new. Is it new? I don't know. Maybe I'm just a bit blind. So euro dollar is getting a bullish reading. See, this is my idea here. Well, not my idea. This is what I'm expecting here. So we can see this red one. So I'll get 1.18, 1.16, close, try and close. Hold on. Entry mark 1.17. I'm not exactly sure what I assume that the red line I'm looking at is the second red box because I'm getting confused between the max entry as well. So I assume it's saying about 1.16, which does line up with what I'm trying to say as well. So that makes a lot of sense. I like it. Let's have a look at what's going on for gold. So gold's bearish. Technical bias is bearish, which again, I do quite like it. I would rather be a seller of gold right now than a buyer. Yeah, tricky. Dollar Swiss, I think, would be a nice little offset. So let's go and have a look at dollar Swiss. So if I did want to be a buyer of the dollar, I think dollar Swiss would be quite a nice way to hedge some risk. Although I would also really like to be a buyer of this double bottom. I think this could be a huge opportunity. However, I also think we could get quite a nice hedge. Excuse me. So let's say, how would I say this? Let's say CPI comes in hot, dollar starts to rally, but then we come to the 1st of August and trade tensions start picking up, the dollar starts taking a hit, inflow to safe havens like Swiss and yen start picking up again. This might be quite a nice opportunity to go short dollar Swiss. Dollar Swiss short at 200 EMA on the H4. Yeah. The only time it touched really was here at 29th of May. Is that what you're talking about? Or are you saying you're waiting for a touch on 200? Okay, so that's dollar Swiss. Pound dollar, actually, I didn't see this. Pound dollar is getting a bearish reading, which I like. Why though? I've completely neglected the pound recently. I've got no idea what its recent releases have been. Oh, patiently waiting. Makes sense. Seasonality is bearish. COT data is bearish. Retail is bearish as well. Trend's bearish. Is the trend bearish? Manufacturing PMI, service PMI, inflation, and unemployment rate. Okay. So both say technical analysis indicates potential. Yeah. Okay, fine. Well, that's interesting. I didn't see that earlier. So maybe a pound dollar short is in play. I'm going to have another quick look. Where's it gone? Yeah. So this is quite an aggressive entry because I'd be selling into an uptrend here, but it might be worth it. Half risk, just go for a 1 to 1.7. Maybe. We'll see. We'll see. It's not now. I'm not going to take that, but something to keep in mind. There's been no economic data recently on the pound. Right. Okay. Yeah, it's kind of boring at the moment. The market's slow. I mean, I think obviously we've got FOMC coming, we've got CPI coming, we've got the August 1st tariffs. I think we're really just in a, as the central banks are saying, just wait and see. Because I'm finding absolutely nothing to do in these markets really, which is why I've started trying to build a statistical model because I've just got nothing in terms of swing trades really. So the markets are in cautious optimism mode. We've got a score of 58. FOMC minutes is making up 15%. We've got tariff uncertainty, geopolitical tensions, and Nasdaq's resilience apparently is what is making up the market optimism. Sorry, someone's spamming my phone. Just had to make sure it wasn't important. Okay, so yeah, if I had to put money on it, I would say the dollar likely is going to come up a little bit higher. It's going to double bottom. It might even do a slightly lower low. I don't really care too much. But from there, I think either we take out this low from a lower low and come back higher, or we double bottom here and then start potentially coming higher and continue it, or starting the next cycle on the dollar. That's my prediction. So I'm not saying 95 can't happen because actually I think it is likely to. But yeah, just the way it's setting up, it just seems too perfect. I would rather be a bull here than a bear, because even if I'm wrong as a bull, that's fine, because the potential payoff of being a bull in this situation outweighs the potential payoff of being a bear, in my view. So that's my rationale. Maybe I'm coping. Don't know. Eurodollar is just not doing anything. It's having some real trouble breaking below support, which is a bit frustrating. DAX running quite nicely. Dollar yen, I'd quite like to go long dollar yen actually. A little bit of a contrarian idea. We do have bullish EMAs here. So I'd be looking for sort of a pullback into the 200 and then continuation higher. Fairly sure that would be quite a nice fib level as well. Yeah, there we go. So that would bring it into sort of the 50% retracement zone, which I'd be quite happy to buy into. So that's my idea on pound yen. Should have a quick check up here. £0 doing nothing. New Zealand yen's flat as well. Yeah. Interesting. Still wanting to buy silver, but again, it's just too expensive in my view right now. Still got a target of 40 on silver, but I just don't want to buy at 36, target at silver, and then price come back down towards 34 to retest previous structure. Pound Swiss, as I said, I think I've missed that one. I'd be quite happy to buy Nasdaq if we can come back down into these previous highs. Again, for that very typical break which we've had, and then the retest of this level, that would also pull back into our 200 moving average. It would come back into the fib level as well. I think this would be a very, very simple, beautiful trade, actually. Actually, what pullback would that be? Let's see. As I've been hearing, word on the street is that we might see sort of a 10% pullback, which wouldn't surprise me, to be honest, with the huge rally that we've had since we had that tariff crash, if you will. That rally presented really no pullbacks or no meaningful pullbacks. We had one here, but that's it. For swing traders, there was no way to get into this market really, unless maybe here if you're quite aggressive. But yeah, it was very, very tricky. So I think some sort of pullback would make sense. Remember, 10% is completely healthy. That's still halfway of a crash. So I would say 10% is definitely possible. Dollar CAD, maybe. I think dollar CAD's had a huge hit. I think it might be a nice opportunity to go long dollar CAD, but I don't know enough about oil at the moment to justify selling Canadian dollar. And that brings us full circle back around to gold. So there we go. 34 for silver would be bang tidy. Trump 30% tariffs on Libya and Iraq, 20% on Philippines. It's all right, no one cares about those countries. They're not going to do anything. I mean that with all due respect, but I'll be honest. Who cares? I don't think Libya and Iraq are the ones that are much of an issue. 25% Brunei, 30% Algeria, 20% Moldova. Okay. Interesting. It seems like Europe, or from what I've heard, Europe might get away relatively easily because I know they rejected 10% tariffs. So it's, from my view, it might just be a case of who's going to lay down first. Is Trump going to roll over and say, okay, no tariffs? Or is Europe going to accept a 10% tariff? Hey, Nick.
Hey, James. Sorry, I didn't mean to cut you off. Keep going with what you were going to say. Europe tariffs. Keep going.
No, that was pretty much it. I was just trying to sort of think out loud about who or what the tariff scenario could be between the US and Europe. I've got no idea because Trump's quite stubborn. Europe, I'm not sure will accept 10% after already declining it. So it'll be interesting to see.
Yeah, should definitely be interesting to see how that all plays out. It's been kind of an interesting development in terms of, the progression of things, right? Because you've had initially there was like this hard set deadline, and then we extended by 90 days. And now that the 90-day period has ended, now the question is, now we're hearing from the White House like, oh, it's August 1st now. So the needle is clearly moving. And I think that's why the stock market loves it, right? The market's like, okay, they're not holding anybody to the fire on this stuff. So I think that's why you've had such a dramatic push higher. And then your thoughts on indices are definitely valid. You've got this concept of very little pullbacks on most of the broader indices, and it's been a tricky year. Unless you were, I sort of had a bit of, I don't want to call it luck because it wasn't necessarily luck, but for me in my own portfolio, I had a circumstance in which going into this year, I was very cash heavy and long gold, which ended up being like, you couldn't have been better. But specifically, the reason I did that was because when Trump won, it was not a political. I was long into the election night. I rode that for a little while, and ended up getting trailed out of some of the positioning that I had long the indices. So I did catch this on the election, announcement, the big push up in the Nasdaq. I was long for all that, but then ended up actually getting trailed out. and just so happened to essentially be out of a lot of my positioning for some time. And then I was actually out of my positioning for most of this first leg drop. Then I started buying stocks along the way down, which kind of, again, not necessarily luck, but just sticking to my rules of trailing stops and, sticking with that. But just goes to show, markets are so difficult because, again, if I was not in these trades and I, was looking for pullbacks, it would have been quite frustrating because there's not been very many good, healthy corrective pullbacks. It's just been this straight shot down and then this straight shot up. And it reminds me so much of COVID, actually. Very weird. I just never would have expected this to take place the way it did in COVID again. You had just this immediate, all flows to the downside and then just straight line up. And it just is so nostalgic. I mean, not nostalgic, but like it is so eerily familiar to that time. Everybody did like the exact same thing. Everybody drew their fibs and they marked up the 38.2, the 50%, and the 61.8. I remember everybody doing this on social media back in 2020, and it just blew through all those levels and just ripped to new highs. And then now you've got this circumstance where we literally did the same thing and everybody was drawing their fibs. It's like, it's just weird how repeatable that is. So are we going to go into some melt up? I don't know. We'll see. But very little pullbacks.
Yeah. We'll see. I think, as we've already discussed, with tariffs on pause. So I think depending on that, we've also got CPI coming as well. So there are some potential catalysts for markets to have a little bit of a shift, whether it be pullbacks, trend changes, whatever it may be. But yeah, I think for me anyway, it's a case of just waiting. I can't really do anything because a lot of my trading is around the dollar. And I can't justify being a buyer or a seller of the dollar just yet. So there isn't anything to do in my case anyway, really.
Yeah. No, the dollar's been tricky for me too, because we've seen some conflicting economic data, and it's kind of like when it comes to trading the dollar, these moments are not as fun for me because I now have I think you were here when I was discussing this the other day. I did a deep dive on the US economic heat map and why it's just giving me such a neutral reading here. And for new listeners, James and I are both pretty macro heavy traders. We will look at, what's happening with inflation. We'll look at jobs reports. We'll look at all these economic readings to help try and decipher, look, which way is the wind flowing? We don't know with certainty what the market's going to do. Dollar could go up, it could go down, but all we're trying to do as traders here on YouTube that do this every single day, all we are trying to do is trying to gauge which way is the wind flowing. And the wind, for my analogy's purpose here, is the fundamental analysis that we do, right? It's ultimately the economies of the world. And in this case, when talking about the dollar, it's the US dollar. And so right now I'm at the same point where I'm just like, we've got some things positive, some things negative, and I'm left with this neutral sense on the dollar. But then I look at the dollar, and if I'm feeling neutral, I'm also feeling like, okay, this might actually be a little oversold too, right? So I'm kind of in this thing where I was bearish for the dollar for a couple weeks here, or a couple months even on the dollar, more on the bearish side. But now I can't really justify getting way more bearish down at these levels when my economic heat map that I just showed you is getting all sorts of neutral readings on it. We had a good jobs report. So I'm waiting, probably like yourself, James, for the dollar to kind of either base out and start moving higher with some good, perhaps a hot inflation print or a round of good economic reads, or to substantially move lower on some weakening stuff. But right now I'm very in the neutral camp too.
Yeah, well, that's the thing. I think even if the dollar did decide, let's just say tomorrow it goes down to 96, I still, from a technical view, don't really think I could be a seller. Just from a technical view, I'd need to see some sort of pullback, whether it be a small one just to previous resistance or a 50% retracement, whatever it may be. Hold on, let me pull this up, like the H4. So this, to me, even if I sold it down here and it broke all the trend lines, technically the bullish idea is gone. I still couldn't sell it. So there is just no way into the dollar for me right now unless we have good data and it comes up, or we have a natural pullback up, then start going down on bad data, whatever it may be. But yeah, I'm just finding it very, very tough right now.
Yeah, it's interesting because here's the reality for most of the listeners here. We are mostly traders that are shorter term in nature, but when it comes to Forex, I actually am I think I'm in the minority of traders that I'm like way more focused on when it comes to Forex. I'm way more focused on like the weekly and daily chart levels. Like I'm looking at long-term currency moves as kind of as a bigger picture to what I do. But most traders are really just focused on the here and now, which makes sense, right? The here and now, the recent momentum for the dollar has been bearish. But I do appreciate that, you've been talking about this, and I've seen some of your content recently, just about that longer term, the secular overall longer term demand for dollars, I still think is very high. And this is where you get into, something kind of interesting where a lot of our studies here that we talk about on the show, in our macro, a lot of them, there's macro from like a midterm length, which I would say a lot of this economic heat map stuff is a little bit more midterm. Like it's not like super, super long-term focused. Now, if you wanted to do, and this might be a future Edge Finder tool, is if I wanted to look at like long-term trends on currencies, what I would probably do would be I would ignore the actual versus forecast components, right? And what I would actually just look at is only the actual. So if I only looked at the actual absolute readings of like the US GDP numbers, US PMIs, they change very gradually over time. It's a very long-term thing. Instead of looking at forecasts and actuals, which is more like medium-term to short-term trading, if you wanted to be a long-term currency trader, which is obviously a lot more of what I tend to do, I typically will look at, CPI on a big picture, 2.4%, rather than like focus on where it was expected to be, but rather where it is on an absolute basis relative to other currencies. It might be an interesting indicator to work on. Like if we were to compare, like if you were to compare the euro against the dollar, right? Just on CPI, for example, CPI in Europe's at 2%. If you were to compare that 2.4% in US, we would expect as a longer term force that higher inflation should keep rates higher in the US, right? So that's like a long term. It could move 1,000 pips in either direction in the meantime, but in the longer term picture, right? Something like CPI, GDP, jobs numbers, unemployment rate, these stats on a long term basis. And I'm talking through this, I'd like to build something like that because I think
it would be good. I'd use that tool.
Yeah, like something just really focused more on the absolute data. Now, again, from a trading perspective, for like 9 times out of 10, I typically do like to look at the short-term expectations of the market versus what's actually happening. But from an absolute basis, might also be good to look at it that way.
I think that would be, I think that'd be good because I'm a big believer in the efficient market idea that short-term data gets priced in quite quickly, if not almost instantly. But you can get these deviations where, yes, in this example, the dollar's core data is actually okay to neutral, but the dollar's value has decreased quite significantly since the start of the year. So having an objective longer-term outlook can definitely help filter out, is a currency undervalued, or is it sort of at fair value, if you will? I'm not sure if that makes sense. It made sense in my head.
I've got one more to show you, James. This might be interesting to you. So another really cool tool is another way that you could do economic data is you can look at it from a forward projected range. So I'm looking at, and this is possibly the easiest version of what we're talking about. At the end of the day, currencies trade based on the strength of the economy. The easiest reading to strength of an economy is the GDP number, because the GDP number takes into account how interest rates might impact things, how inflation might impact things. GDP takes into consideration a lot of that stuff. So this is an interesting study because if I'm looking at GDP going forward, right? We just finished up Q2 2025. We saw during that period the finalized numbers for GDP in the US were down by 0.5%. But if we look forward, projections for Q3, for example, the US is expected to significantly outperform peers, 1% versus the euro, which is expected to see 0.2% GDP growth, and the UK, 0.2%, and Japan, 0.4%. In Q4 of 2025, expectations are for pretty much dollar dominance in terms of GDP growth, 2.1%. The euro is 0.3%, UK 0.3%, Japanese yen or Japanese economy expected to grow by 0.6%. So these are projections. They're all over the place and they change over time. But this is just a interesting thing I think of when it comes to trying to, is the dollar dead? Well, look at forward projections. The U.S. economy is expected to significantly outperform in terms of growth than other places. So I know this is like high level, boring macro stuff for some, but for James and I think this is interesting stuff. So it's really important too.
Yeah. Well, this is what moves markets. So, it might be boring, but it's important.
Yeah, absolutely.
Yeah, I mean, I think the other thing, and this is kind of leading off from what you just showed about the more long-term idea is looking at economies from on a relative view. So yes, the dollar might be down, 11% give or take this year, but is it really worth less than euro, or how is the data compared to the eurozone data? And on the Edge Finder, for example, the euro dollar was positive 10 at one point. It's dropped down now to 5 or 6 or something.
Mm-hmm.
So it's about, being able to sit and say, okay, the dollar may have dropped 11%, but it doesn't mean euro dollar is now going to continue to rally or the dollar is going to continue to fall. You've got to have that ability to say, okay, this is the stats as of today. Is there a valid trade? If so, why, etc. And it's been able to just have that ability to build a forecast, whether it be long term, short term. But yeah, I'm not sure where I was going with that. But anyway.
Yeah. No, I mean, I think we're resonating the same idea. Essentially, looking at the absolute strength of the economy is a little bit different than the relative to expectations strength. Again, from a trading perspective, from a shorter term to medium term, I much prefer to use the forecast versus expected or actual versus forecast kind of approach. Yeah. But if we do want to take a look at longer term holdings or position trading or scaling in, scaling out from a big picture, if you ask me, do I want to hold the dollar versus the euro for the next, 6 months, I'm probably going to lean more on the dollar. James, I'm going to take over the show in just a second, but I've got an important phone call coming in. Can I just back out and come right back in just a minute?
Yep, of course.
Okay. Sorry about that. Yeah.
No, okay. Can we quickly overview the Edge Finder? Of course we can. Here are the setups. I'll leave those there for a second. Are you holding You're holding your gold bias for FOMC. I assume that's for Nick. I would assume Nick is going to hold it. I don't want to speak on his behalf, but yeah, I would assume so. So Mangst, hawkish. I assume you mean the FOMC will be hawkish. Maybe. I don't think it could really be dovish. It might just be slightly hawkish, mainly neutral, I would expect. He's back.
Okay. Sorry about that, James. Okay,
no,
James.
Okay.
Yeah, I have an electrician coming to my house, so I just had to take that call to make sure they're on their way.
Okay, cool.
Anyways, yeah, James, I'm gonna kick you off because you've been on for a while, and I know you're probably getting tired. So
yeah, all good.
Thank you for sharing some knowledge with the squad here. Everybody, if you enjoyed the commentary from James, make sure to go check out his YouTube channel. It's FOREX James on YouTube if you want to search it up. It's FOREX as you see right here. I'll put it up on the screen. FOREX James as you see it there. Search him up or click that link in the chat. and subscribe. James, thanks very much for coming on, man. I appreciate it.
See you later, guys. Have a good day.
Yep. Fascinating conversation. Also, just a bit of a PSA to the producers. So I have a electrician coming by my house somewhere between 12:45 and 1 p.m. So I'm going to most likely make it, I would say, to the next stream, pass it off to Chris. But just in case, producers are going to maybe try and have something prepped just in case to stall for time if I need to hop off the stream to answer the front door. Anyways, if you guys could do me a favor too in the audience, if you guys have some questions that you would like me to go over during this stream, we'll drop a link here in the chat now to where we can collect some of those questions now, and then I'll answer some of them later on in the stream. If you have a question, if you're asking about risk management, or you would like to know something more about fundamental analysis, take a second to fill out this form. It is completely free to ask a question. This allows me to save it in my in this portal that we'll have it in, and then I can pull it up on stream and answer your question. So let's see. Take a look at how things are moving here today. Guys, I've been on camera since 8 a.m. and I am loving it. All right, so indices had a big pop then drop. And see how, wait, hold on, let me fix something. My pin, see, look at this. See how I can click on this and I try and draw and it doesn't work. Hold on, let me try and fix this. Okay, try this again. See if I can get it to work now. There we go. All right, it works. Okay. So let's take a look at overall markets moving today. S&P 500 pushing higher, then dropping back. Same thing with the Nasdaq. Gold trending down, but a little bit of a pop here today. Gold trading at 33.11. Dow Jones dropping pretty hard here today, and Russell holding up decently well. Dollar index flat for the day. Oil prices also pretty flat for the day. And I don't know if you guys saw this yesterday, but copper absolutely flew. Is anybody trading copper right now? I'm just curious. Any copper traders out there? Also, Chandler, if you're listening, I think that conversation that James and I had about the US dollar there was really good. That might be a good segment to include. I'm going to try, if I don't collapse, I'm going to try and film a video after we end stream today. And if we that clip between James and I thought was pretty good. He had some good thoughts on the dollar longer term. It's a challenging one, right? The dollar index feels like it just falls every single day. It's really hard to try and call the bottom on this one. But I also, I definitely can't justify getting super short either. Because if I take a look at this, right? If I look at the economic surprise meter, US dollar is smack dab in the middle, getting a 54% read. All that means is that relative to forecasts, economic data is pretty split in the US. Compared to somewhere like the UK, which is more negative, Europe, which is pretty positive recently, Japan's neutral, the Kiwi dollar is strong compared to forecast, the Canadian dollar is very weak, the Australian dollar is very weak, Swiss franc very strong. So I'll call myself out on this because some of you guys know I'm long CAD Swiss. Why on earth am I long the Canadian dollar versus the Swiss franc at this time? And this is going to look silly. It always does. When you have a trade that's gone wrong, it looks pretty silly. So here's CAD Swiss, right? CAD Swiss is a chart that has just continued to trend lower. And I'm stuck in a drawdown on this trade, but there's some context that really matters. I have, first of all, a tiny position. So let me actually go through this. I'm gonna bullet point my conversation about this. CAD Swiss trade. So let me just see if I can pull something up here. So if I'm looking at CAD Swiss, right, I have two positions. One around here. So I have one long around this area, let's call it. And I have another position. These are just rough areas around here. So this is my CAD Swiss trade, roughly pictured. So first of all, why the heck am I in this trade? Well, first and foremost, when I took the trade, I didn't think the market was going to continue to go lower. I thought there was a good chance that this market would actually reverse and push higher. So I added a trade here, and then I added another trade here. But there's a couple things that are really important. You might say, Nick, that's how many pips is this? 360 pips away from your entry. What the heck is going on? Well, the first and foremost thing is that trade size is tiny on these positions. The overall drawdown in the account from this is less than 1%. Okay? So the trade size on these trades is tiny. It's hardly impacting the account. So why am I still in this trade at all? Well, the reason I'm still in the trade is because I use a dollar cost averaging approach in my Forex trading. And so I entered once and I entered a second time, and both trades are now underwater. And the fundamental analysis that I initially did on this chart has changed. What seemed like a good setup when I took the trade has gone wrong. In fact, now, as I just showed you on the Edge Finder, we're getting pretty much the opposite signal. The Canadian dollar is getting a very weak reading, saying actually to be more bearish, right? Based on the economic data. And the Swiss franc is doing the opposite. It's getting strength. So again, I'm on the wrong side of this trade, and there is no defending whether or not the Edge Finder is bullish or bearish on this. It's straight up bearish. So I have a small trade size. I have two entries. And the question is, now what? Because I imagine some people are wondering, so why don't you just close out of this trade? Why don't you just close out of this trade? Well, remember, first of all, the trade size is so tiny. Fundamentals have changed against me. I have two entries. Here's the reality of this trade. I was wrong about this idea to be long CAD Swiss. Okay? And even though I'm wrong, even though I entered twice, both were bad entries, even though all of this kind of worked against me, I am down less than 1% on these trades. So now what? I was wrong. Now what do I do? Well, now I'm looking to get out of the trades, but I'm not worried about rushing to get out. So instead of just closing out everything, I'm going to look for a bounce in CAD Swiss to close out. Now, this is very much not what is traditional Forex YouTube stuff. You know, traditional Forex YouTube stuff is trading the 1 minute chart with a tight stop loss and trying to double your account in the week. But if you watch these live streams, if you watch people like who was on earlier, Forex James, Chris Pulver, we are boring Forex traders and proud to be boring Forex traders. When I trade Forex, it is like watching paint dry. My position size is very tiny. It's longer term in nature. We're collecting positive swap, and we're just doing it day in, day out. And we're not really worried about what the market does most days. In fact, I check my Forex account like twice a day. That's it. Not very frequently. And so what am I doing in this case? Okay, so I'm wrong. I want to get out of my CAD Swiss trade, but I don't need to rush. And I think market is a little oversold here. So if we can get a retracement, I'll close out. I'll realize losses on these two positions that have gone wrong. So I'll close out this trade and I'll close out this trade. But I'm not too worried even if this thing goes lower, right? I'm going to wait for price to jump up as a point to exit my trades. Why can I afford to do that? Someone also said in the chat just now, not very useful for small accounts. That's correct. I mean, to an extent. You can still do this on a 5K, 10K account, but you definitely do need to have a little bit of liquidity to approach this, in a slow and steady manner. So with CAD Swiss, I am looking to exit the position, but I'm not in like a scramble to stop out because the account's getting destroyed. No, none of that. It's a tiny, tiny trade. So that's my CAD Swiss trade in a nutshell. I'm looking to get out. Would like to get out if we can get a pop up to like 59.50. I'll take a loss at that point and be back to square one. If the market continues to move lower, if the fundamentals still don't look great, I'll just hold the trade and I'll look for an opportunity to close out that way. Essentially, I'm going to look to close out of this basket of trades that have gone wrong against me on a bounce, not at the lows. Now, this is definitely, again, it's not standard Forex trading. But to be fair, what's most standard in the Forex world probably doesn't work very well for most people. This approach has worked really well for me for years. It's very boring. It's very slow and steady. You're not going to get rich quick doing it. Tiny trade size, small winners, stacking it over the years compounds into bigger and bigger accounts. But it's not an exciting way to trade. And guess what else with CAD Swiss? Every day that goes by, I get paid to hold this position. It's not a lot of money, but I get paid a positive swap. The interest rate differential between Canada and Switzerland allows me to hold this trade and get paid positively for doing so. So I don't know if that, again, this is not for everybody, but I'm telling you an example of a currency trade that has gone wrong for me and why I essentially do not care. It is such a small trade. It's not hurting. The fundamentals have changed on me. I was wrong on my timing to get long on this thing. It's gone against me. It is what it is. Now I'm in trade management mode. Trade management mode for my losers in Forex just means waiting for an opportunity to close out for a lesser loss, essentially. So there's CAD Swiss. And again, in the meantime, you know what else has been cool though? The whole time that I've been dealing with this drawdown, I've traded a bunch of other currency pairs and cashed in profits along the way. So while this one has been kind of a drag on the account, I've been able to keep things, going steady by trading multiple other currency pairs. It's one of my favorite things about Forex is you can trade a huge basket of different things and be in all sorts of different trades. Here's another one. So I'm short Euro pound, another one that has gone against me. That is collectively less than a 1% drawdown on my account. Drawdown from this Forex pair, less than 1%. If we get a rollover in this one, I may actually be able to close out for about break even on this loss, which would obviously be more ideal than taking a loser. So we'll see. Guys, we've got about an hour and a half before we get the federal or the FOMC meeting minutes, which will give us some information about how the Fed is feeling in terms of the jobs report that we got recently, inflation, and most importantly, what they intend to do, potentially some clues about what they intend to do with interest rates. Now that I've talked about my baggage in Forex, let's also now take a look at some Forex trades that actually look promising. So I mentioned earlier, currencies that are looking strong right now would be Swiss franc, Euro, New Zealand. So I actually just took a short, and I am interested in potentially taking a secondary short on the Australian dollar against the Kiwi. So some of our weakest currencies would be CAD and Australia. So I'd be interested in potentially getting long things like NZD CAD or short Aussie dollar versus Kiwi dollar. So if I pull up NZD CAD, for example, this one actually might be a serious contender for a possible long setup for me. Because when comparing the two, we're sitting at a support level on the daily chart. Prices come down here. Actually, this is looking really interesting. Hold on. Canadian dollar is looking weak from a number of reasons. You have PMI numbers that came in worse than previous. GDP growth came in soft. CPI came in neutral. But then we take a look at New Zealand. Very interesting. Yeah, this is probably a trade for me. I'm probably going to take a long on Kiwi CAD. This would also balance out my long exposure to Canada, which would be awesome. The other thing that I do with currencies that is not standard is I do a portfolio approach in Forex. So when I trade currencies, I'm not just trading one currency pair, tight stop loss, lots of leverage. It's actually like the exact opposite. I'm trading many currency pairs, tiny lot size, very little leverage, longer term. It's the exact my currency trading approach is pretty much exactly opposite to what is standard on YouTube. And that's the way I like it. You know, I want to be doing something that I don't want to be doing the same thing as what everyone else on YouTube is doing, because most likely that's, you know, if most people lose money, you probably shouldn't do the exact same thing. In fact, guys, I'm gonna take this Kiwi CAD trade. This one looks good. What's the swap like on Kiwi CAD? Kiwi CAD. I have not traded this currency pair in a long time. Swap long is positive. Very nice. Okay, NZD CAD. Yep, this is a long for me, I think. Now, granted, remember, when I say I'm getting long on something, especially after I just showed you my trade's gone wrong, you could, ready for this? I could be wrong about this, and you could make money doing the opposite of what I do, and I could still end up making money. That's the beauty of dollar cost averaging. Like, I might be early to this idea. I might actually be getting a good trade here. I have no idea in terms of short term what is going to happen for certain in the market. Nobody does, right? So I'm going to go ahead and get long here. I'm buying the New Zealand dollar versus the Canadian dollar here on a couple different accounts really quick. So let me just get this in on my Oanda account. I have a couple different brokerages I use FX for, so I'm just going to set this up. So if I go, what did I say? NZD CAD. I'm just going to use a market order here. Get long over here. Okay. Well, guys, I may need to call in that that order to take advantage of this electrician showing up. James or Chandler, I hate to do this to you, but if one of you guys could help me cover this, I'm just getting a phone call now. If we could go to a break really quick, I'm going to answer the phone and see you guys later. We launched the Edge Finder 3 years ago in April of 2022. And now, years later, the tool has helped thousands of traders take their fundamental analysis and sentiment analysis to the next level. Traders can track things like the commitment of traders data, which shows institutional money flow, whether they're buying or selling certain assets like gold and currencies and indices. Additionally, we've made economic heat maps that allow traders to track easily the fundamental or economic data trends that we're seeing in markets right now. You can also track retail positioning and see what the market sentiment on your favorite assets are right now to look for some contrarian signals. And of course, it strings it all together with the top setups algorithm, showing traders the most convicted top ideas that the Edge Finder is producing now. The Edge Finder has helped traders go from beginner to pro in terms of the fundamentals, and has helped many traders go from unprofitable to finding the missing pieces in the name Edge Finder. So if you're not already using the Edge Finder, let me tell you about the biggest discount that we offer all year long, starting right now. The 3-year anniversary sale is going to be our biggest discount that we offer all year long, and it is now available to people who are watching right at this moment. Traders looking to get access to the Edge Finder can take advantage of this massive discount for a limited time using the link in the chat being dropped right now or in the description of this live stream. If you've been thinking about getting a copy of the Edge Finder, do not miss this opportunity. It is the lowest price that we do all year long, and it's a one-time payment to get access to the tool. So don't miss it. Celebrate 3 years with us by getting yourself a copy of the Edge Finder at the super discounted prices. Thanks for watching. And now back to the show.
All right, guys, like Nick said, he's dealing with some electrician stuff. Also, can y'all, oh, actually he's back. Nick, are you good to go? Okay, he's good to go. Never mind, he's coming right back.
All right, false alarm, guys, kind of. They're still on the way, but it was a different phone call. We may still need to have James or Chandler step in for a second, but okay, let me finish my thoughts here on this trade I'm taking here. Okay. Okay. I'm punching in order now. Getting long NZD CAD. I am really getting a phone call. James, could you mute me for a second? I'm just going to answer this phone call, but I don't. All right. Sorry about that, guys. It's the reality of all day streams as I got stuff popping up. Okay, so I'm trying to get this trade punched in. Going long NZD CAD. NZD CAD. All right. All right. So NZD CAD, reasoning for the trade, pretty straightforward. Outperforming economy versus a softer economy here recently. I'm just going to mark up this screenshot. You guys are really getting the behind the scenes showcase today. All right, just going to circle what I'm looking at here. So we have NZD getting a strong reading and Canada getting a soft reading. By the way, if you want the tools that I'm using, the Edge Finder is currently on super sale right now. It's the biggest discount we do all year long. Currently, you can get 45% off. If you don't want to sit around and watch me painstakingly write this up, you can currently get 45% off our signals or the Edge Finder, both of which you can get some information on by clicking the link being dropped in the chat right now to speak directly to our support team. Don't miss that. We're doing our summer sale right now. It's the biggest discount we do all year long. 45% off the Edge Finder, which is the market scanning tools that I use, or you can get access to the signals for 45% off. Send us a direct message there. All right, let me include that screenshot here. In the trade alert. Small initial long position on NZD CAD, NZD economic strength relative to forecasts. CAD economic strength weak, economic weakness relative to forecast. Key area of support. Would be willing to possibly add to the trade around, what was that level? 79. All right. Everything looks good. All right, good to go. Perfect. Okay, just took that trade. Last thing I need to do is update it in our trade tracker. So give me one more second to do that. Okay. Should be good there. All right, let me just check. All that is up to date. And there we go. Should be up to date in the trade tracker. If you do not have access to the trade tracker and you're a VIP member, let us know. Send us a direct message on the website. You can get access to it if you're a gold VIP member. You can also get access to all of our fundamental analysis course material, technical analysis course material, risk management we're still working on. We have a getting funded guide on strategies on how to actually get funded, and Edge Finder explained, all sorts of stuff. You can go through my trading strategy, and of course you get access to the trade tracker. If we remove stocks here for a second, just look at currencies, you can see I'm sitting in some drawdowns on CAD Swiss and Euro Pound. Sitting in a neutral trade because I just took on NZD CAD, a long position on gold, which is working well. The German DAX I'm up quite a bit on, and the Russell I'm up quite a bit on. So sitting in some currency pair drawdown and indices and commodities are absolutely killing it. Yeah, so we'll see. Completely bearish on euro. What's your thought? I'm going to take the other side of that. I'm very bullish on euro. Why would I be bullish on euro? Well, first of all, the momentum looks incredible. Now, when I say I'm bullish on euro, I do want to disclaim, I'm not saying bullish right here, right now. It should go higher. But if you were to see a push down into 116, 114, 113, this general range, I'd be more bullish. At current levels, I'm pretty neutral. But if you were to get a bigger pullback into this range, I like the idea of some more bullish setups. If I take a look at the fundamentals on euro and why I probably wouldn't short it personally, would be take a look at this. Oh, this should be color-coded blue. If we look at euro impact on GDP stats, manufacturing PMIs, services PMIs, most of our economic metrics have been beating expectations for Europe recently. Like GDP numbers came in strong, PMIs came in stronger than expected, both on services and manufacturing. Retail sales was expected to fall more than it did. That was also bullish. CPI is at 2%. PPI, and that's up from the previous. Unemployment rate in the European Union did tick higher to 6.3%. Most of our metrics are bullish euro, at least right now. Could change, but for now, I would personally, again, your strategy may be different than mine, but for me, I focus heavily on the macro, which would lean me a lot more towards being bullish rather than bearish. So that is my personal outlook on the euro. I'd be more interested in bullish setups between the 116 and 113 range. You know, something like this, I like that setup quite a bit. Now, is the euro a little bit overbought? Maybe. It's just not a trade. I don't play this trade, right? I don't play this trade because, you know, right now, if I have an overall bullish view on the euro, would I be surprised if the euro flew through the highs without giving me that pullback? No. Because the euro's, again, fundamentally very strong for me right now, based on the analysis that I just did. So I would not be surprised if it kept drifting higher without me. If it pulls back, then I'll join the trade. But if it doesn't, I wouldn't be shocked. I would just be like, well, fundamentals look strong. So until that changes, I will not be surprised by the euro continuing to strengthen against other majors. Indices regaining some ground. Look at the DAX today. DAX is absolutely on fire. I did end up trailing stops further in the VIP room. In the index trades channel, I trailed stops on German 40 of the DAX. Big break this morning, looking really solid. Quick look at stocks as well. Robinhood just will not quit going up. This is both awesome and frustrating. I'm short covered calls, or I'm short calls against my existing position, aka a covered call position. I have a 95 strike price, so price is still. I want essentially Robinhood to stay flat or move slightly lower in the next month, so I can keep my shares without getting called away. Google's up almost 2% today, or was up 2%. Nvidia's up 2%. Meta's up 2%. American Express. Ooh, I have options on American Express. Let me look at those. I have options expiring in 3 days on American Express. I sold calls. I'm down $300 on those calls. I could roll these out. Let me just I'm sorry I'm diving into options. I know I'm not supposed to on this stream, but I need to look at this. Okay, so, and the reason I say I'm not supposed to is because I have another YouTube channel dedicated to stocks that I talk about, and I'm trying not to cross into this channel too much about stocks, but I do just want to take a quick look. If I roll this out 310, can I collect a premium for doing that? What is American Express doing today? AXP. I love the stock. I mean, American Express is a stock I love. What are we down? Where's my daily performance on AXP? All stocks. Anyways, AXP's down today. We've given back from these highs. Give back 3% on the stock, 3.5% on the stock. I think I may roll this. And again, I'm sorry to go right back into writing up another trade, but it is live trading. So sometimes live trading is a little bit boring in terms of waiting for me to punch in orders. But hold on, I'm thinking about rolling out these calls by another month and collecting another premium. But let me look at two options. I could roll them up to 320, which I want to look at doing. 320, you're looking at the 50 delta 320 calls. If I'm looking at rolling them out to August 8th, I have one contract that I can do. How much is it going to pay me here? 10.15. So I'm looking at, if I rolled out create rolling order, I want to close the 310 calls, take those back for a small loss. And then I want to sell the 320 calls. I should get a credit here. August 8th, 320 calls. Yeah, I'm going to get a credit. It's not going to be beautiful, but I can keep the shares and I can keep collecting premium and I can hedge my portfolio a little bit. It's only $182, so it's not a big premium. But let me just throw this order out here at 190. See if I get filled. Okay. All right. I'll put it out there. We'll see if it gets hit. What I am essentially doing is I am selling a call. If you're familiar with calls and puts, I just sold a call to someone else in order or in exchange for offering that bet to someone else. Someone else wants to make the bet that American Express is going to be at 320 or above. If that hits, they can make some money. If it does not hit, I make the money, right? So it's like selling bets. Anyways, I'm going to keep an eye on that. If that fills, then I will publish that in our group. Gold with a little bounce back here today. DAX very bullish reading, still strong, still in this trade. Stops trailed on it. Russell's trailed. Gold, looking for gold in terms of what I want to do with this one. I'm looking for a breakthrough this high at the very least in order to trim some more on my stop loss. So if we get something like this, if we get closure above here, right? That will be a good point for me to take this stop loss and move it right up to just in break even below this area. So that is a homework assignment for me tomorrow. If we get a break higher on gold, we'll see. If we don't, I'll stop out. So I'm either going to take a small loss on gold or I'm going to trail stops on it. Yield's a little bit lower today. 2-year yield. Bitcoin's up a little bit. My best guess on Bitcoin, and it really is a guess, momentum is to the upside. I feel like one day you're just going to wake up and it's just going to be boom up to the 115s. Who knows? Maybe it'll be tomorrow. What are your thoughts on gold, Nick? I just went through it, so I'm in a long. Looking at trail stops on it. Really boring. Gold is really boring lately. It's just gone sideways. You know, it goes in these spurts of like gold is just fascinating to watch. And then gold goes into range-bound markets, in which case I'd just rather be looking at other things. I do have a gold position on, but it's just really, it's tough to watch when it just goes back and forth. In fact, it's probably best that I don't sit and watch gold, because I'd be more likely to sit around here and try and get fancy with this where the chart just wants to go sideways, right? When I took my gold trade, I also mentioned from a portfolio approach that it was a bit of a hedge. I went long gold over here as a bit of a hedge to the portfolio in the event that you get something flaring up in the Middle East again. That seemed to have really calmed down. Saw the big drop in oil prices. Oil prices are bouncing a little bit since then. So we'll see. Anyways, I've been mentioning this a lot recently. I'm in a mode where a lot of stuff in the markets we've entered into, and you got to know how to trade the different environments. I feel that we've entered into an environment in which we have gone from a high volatility environment to a very low volatility environment. I mean, the VIX is at 16. We dropped 4.5% again today on the VIX. Volatility is absolutely dried up here. So how do you trade that environment? How do you trade the environment of the VIX? Well, I actually just filmed a video on how to trade with the VIX today. So if you're interested in that topic, make sure you subscribe, hit the notification bell, all that good YouTube stuff. And that video should be coming out in the next couple of days. But how do you trade an environment in which you've gone from everything moving like crazy, news cycle is 24/7, to it's pretty quiet out here? Well, right now, this environment favors upward drift on stocks. Stocks just tend to just grind higher every day during low volatility periods and then give back tons of gains very quickly. So how do you prepare for this time? Well, in this environment, I like to buy stuff for the longer term. In this environment, I like to trail stops on winners, sell covered calls, and trim winners. That is honestly what I like to do in this environment. So I've been selling calls. You just watched me. I just sold I just rolled out my calls on American Express to another month. Rolled my calls on Robinhood stock. So I'm selling calls, selling bullish bets in this environment. I'm not bearish, but there is a time to take profits. There is a time to recognize that high volatility environments precede low environments. Low volatility environments precede high volatility environments. Now, I am not going to try and tell you that this is exactly when we're going to now have a huge high. I can't tell you when, but I do know that when the market gets really calm, that's a time where insurance is cheap. You can buy puts for cheap. You can get paid nicely to sell covered calls on stocks that you may own. It's something to think about, right? And so I've done this for a number of years, and knowing how to gracefully adapt to the volatility environment that you are in is absolutely imperative. Now, it doesn't matter if you trade stocks, options, cryptos, currencies, commodities, like copper, whatever you trade, this applies to you. This environment, currencies, everything trades very differently than this environment. I got to sneeze. Hold on. So just know how to be prepared for all environments. So when there's a low volatility environment, what do I not want to do? I don't want to go buying aggressively calls on high risk stocks, right? So I've done the exact opposite. I love this company, Robinhood. I'm so excited about what they're doing. I think it's a really cool company. Just like everyone else, I am excited about this company. And everyone else is out there buying calls on this stock. There's a very huge amount of calls on this stock because it's a very exciting story. But I am the dummy who's selling those calls. I say dummy because I've had to roll it a couple of times and it's not been pretty. But I'm sitting in this stock and I'm shorting calls, and I own a bunch of shares. I bought a bunch of shares. The stock's up tremendously from where I bought it, but I've been selling calls. And I think it's still an appropriate thing to do, to sell some calls, collect some premium, sit back, build cash, and wait for the next round of market craziness. I can't tell you when that's going to be, but I can tell you when times are really good, I get a little bit more defensive. When times are really scary, I get a little bit more aggressive on a longer term, on my portfolio approach. Active trading wise, what am I doing right now? I'm long alongside everyone else, trailing stops. I'm long the Russell. I'm long the DAX. I'm also long gold, bit of a hedge. So that's my positioning. Up next, guys, we're bringing back Chris Pulver for round 2. I'm going to join him in just a little bit. I'm going to go drink some water, try and reset a little bit. It's been a long recording day for me. But I hope that you're enjoying the stream. We've got Chris Pulver. You're in great hands. He's going to be jumping back on here in just a second. We're going to play a quick break before that happens. And just before we mention that, just a reminder, Edgefinder's 45% off right now. If you've been waiting for a copy of the Edgefinder, now's your chance. In like 30 seconds, you could be getting a copy of the Edgefinder if you don't have one at the lowest price that we offer all year long. If you want some information about how you can get access to the Edgefinder for 45% off, it is a one-time payment to get access to the tool. Click the link that's just been dropped in the chat right now to speak directly to our support team who can get you set up with a copy for lifetime access, 45% off. Up next, we got Chris Pulver just after this.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat. You can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Hey everybody, what's happening? Let's have a look at things. We have about 57 minutes before FOMC minutes drop. We are down just a tiny bit intraday on the day, but markets clinging to green because we had a gap up. So we're looking at 0.27% in the S&P. We had a 0.5 to 0.6 move up in futures, now down only up a quarter 1%. We got the Nasdaq up 0.41. We got the Dow up 0.16. Russell's up 0.53. Russell kind of hanging in there. Just going to keep selling, flipping calls on this thing. I love a pullback. I talked earlier this morning about some of the big earnings catalyst that comes into the end of this month. I think one of the most important months of July is going to be the 28th through the 1st of, so it's the 20th through the 31st, and including the first, which is a non-farm day. Let's actually talk about that for a second. So July 20, is it 27th or 28th? 28th. So July 28th to August 1st, right? So we have big Mag 7 earnings that week. That's going to be Tuesday through Thursday. So they'll drip in, like there's a little bit, I think mostly Wednesday, Thursdays when Mag 7 is packed in. So that's going to be Apple and Meta. Like Tesla is like the 23rd, is a bit earlier. Netflix is a bit earlier, but like that's like your big Mag 7, like Apple, Microsoft, Meta that week. I think NVIDIA is a little bit later in August. What else? We also have the non-farm. I'm going to double check that we have non-farm on Friday, August 1st. And if I'm not mistaken, we also have the August 1st official tariff deadline. Okay. And I say official because it's possibly subject to change. I don't know if it should be changed. I think that's going to maybe let the market maybe scoff at the whole idea. Like, what are we doing? It's just delay. But that's all happening that week. So let me confirm that on that Friday, August 1st, that we do have a non-farm payroll. Let's go to this month. Actually, we'll go to next month. So there's Friday the 1st. So yep, we do have non-farm slotted for 8:30 a.m. on August 1st. I don't see Canada employment, but we have manufacturing PMI and non-farm from 8:30 to 10 on top of the trade deadline, on top of Mag 7 that week. I would imagine that's some pretty high flying price action. For better, for worse, we'll see. I think earnings is really key. I think we have to have like a really amazing earnings season to see these markets justify and sustain these highs. Just because a pullback is now on multiple time frames technically overdue. So I get it that the market can melt up and keep going and keep going and keep going. I get it, which is why the portfolio is tilted bullish, which is why all I'm really doing is just selling calls and putting downside protection out into like the end of the year, just in case something wild happens. I would be shocked if I'm going to put like kind of a forecast out there. I would be shocked between now and the, let's say, middle of October or end of September that we don't have at least like a 5% correction. At least. I think we probably have more than that. I think we probably have closer to like 10% corrections. But a little 5% flush or 5% pullback to me would make some sense. 5% on the Russell gets us, back to around 210. We get into like maybe double digits, it pulls back to 200. I still think the Russell is postured for a pretty good looking move, especially if the Russell is kind of building its momentum and catch up on the Fed likely cutting rates this year, which right now I still think we're at 2 rate cuts based on the futures watch tool for the Fed. Let's go probabilities. So pause, cut. Yep. So this is September and December, looking at 2 cuts this year. I mentioned this earlier. Is Trump trying to put a, basically yes man in the Fed spot coming into 2026 by like May of 2026 when Powell's term is done. Look, at the Fed is being pseudo accommodating. I don't know what's going to happen to the bond market when the Fed starts cutting. I don't think that. I think this is why Powell and company have been very, very cautious. We don't really know the full price effect of the trade war. We don't know what countries are lining up to do business with the U.S. We don't know what actual trade deals we actually have inked. In faith and credit, it's like UK, Vietnam, and a pause, kind of like a frenemies agreement in China. But I mean, what about the Eurozone? What about Japan? What about other parts of the world? I don't know yet, and I don't think we do either. So this 50% tariff on copper, it just shows that this conversation narrative is still out there. creating some uncertainty. The markets are still pretty up and pretty well supported. I mean, I don't want to be a bear. I don't. I just want a pullback. To me, I mean, even a flush, even a flush year, I would be pretty concerned if the market breaks below 5,700. I'd be pretty concerned if it doesn't immediately go back above. Because to me, all this means is this is my pullback zone that would be buy the dip, buy the dip, buy the dip. Like all these levels would be buying the dip. Okay. But if we break below 57 and we don't immediately pop back above, I'd be concerned that there might be some more downside here. It may not take out the lows, but we might have, some type of trade like this where it's like a big nasty broadening pattern. I mean, I think everyone. I mean, give me some feedback here. How annoyed or angry or upset or frustrated would traders be if we're back here again in 2025? I mean, that would be an incredibly volatile market to have a 20+% move, a 20+% rally, a 20 to 30% move all in 1 year. I think that's an insane amount of volatility. Um, I don't think that's necessarily going to happen. I don't think that the narrative is that severe. Um, but I also wonder, like, is there a tantrum on the horizon with Trump if we don't have all these countries lining up to do trade deals? Are we going to try to job on our way to make it seem like we've done the right thing with this trade war? I don't know. You know. Anyway, long story short, there's a lot of support. I still think buying the dip is good. I'm just wondering here by the end of July or into like August, September, that's likely going to be a correction. I think it's more of a surprise move if we have a July correction, if the market kind of rolls over early without having like a major catalyst, right? Now that the market's had another like a sigh of relief to say, okay, now the trade war thing is August 1st. Let's see who comes to the table. Let's see who, announces some, in good faith trade deals with the U.S. That's what Besson's going to be, probably grandstanding about. Trump will probably celebrate it too, whatever they look like. I'm trying to think who was one of the more notable countries this week was like, we should be talking to them. Okay, do we? Are we? It's just, I don't know, man. I'm sure it's going to be fine. In all honesty, it's probably fine. It's just, it's annoying, you know. And to see that all the good stuff is then kind of priced in, it's like, I'm sure there's more upside with like fiscal spending. I'm sure there's more upside with great earnings. And that's a big question mark is will earnings still prevail? Will they still kick all sorts of butt and hit higher valuations? Our profit margin is going to continue to increase. The labor market isn't struggling. People can still get jobs. So that's why this whole recession talk has faded from like a 60% probability down to like 20%. Nobody's really talking recession anymore. I still think that if you look at the fear and greed index, okay, so we are at extreme greed right now. Another reason for the market to ventilate. It just needs a little correction, right? A little correction. So market momentum in greed territory, stock price strength in extreme greed territory, stock market breadth, extreme greed territory, put and call options, extreme greed territory. Market volatility is low. As Nick said, we're down to 16 in the VIX. Now that's like somewhat elevated. That's looking at roughly about a 1% move in the VIX every single day. That's quite high. But the nice thing is as I say this, as somebody that trades a lot of options, the expected move, okay, if we have a VIX at 16, so the VIX at 16, we're looking at about a 1% expected move every single day. Now, you know as well as I do that rarely will that market move 1+%, right? So, I mean, even today the market is pretty. It's been up and down, but for the day, from the close yesterday, we were up around 0.69, down to 0.09, and here we are about 0.28 off the close. Intraday price action for the day, high to low, we've gone around 0.6%. So it's difficult to get a 1% move even every single day with the VIX at 16, which is a good thing. Can the VIX surprise us? I mean, sure. But usually if we're going to see like a big drop that's over 1%, the VIX is going to spike up, probably 5 to 10%. But that's kind of the beautiful thing about having these instruments is knowing like there's a floor and a ceiling every single day. That's what market makers do. They establish these floors and ceilings. So anyway, that's where we're at. News again at the top of the hour at 2 p.m. Let's see if the minutes get the market to move at all. Some intraday levels that I'm watching. I did close out this trade for break even. So this trade is no longer valid. I was upside down a couple $100 and now I went to break even. I just took the profit. I don't want to sit on this thing through the news, because if the news decides to take us lower, I don't want that to be a risk. If the news decides to take us higher, I don't want that to be a risk. I'm just going to get out of the trade at break even. The other trade that I have running is I need price to close outside of this box. So if it stays down here, I make some money. If it rips up to highs on the day, I make some money. If it closes here, which is a 15-point wide dead zone, I have risk on the trade. So I'm trading this a little bit riskier. The news is at 2 p.m. So I'm looking to see if I can get out of the trade for a couple of bucks prior to the news. I might try to do that at the top of the hour. I'm sitting, I think I should be like maybe $5 or $10 positive right now. Let's find out. I am down about $13. I have that is a call side. 55. Okay, so that trade's still running. Let me make sure. So I've got this trade at 62.05. That one closed out for break even. This trade's still running. That trade is pending. So I've got two, kind of in the money. It's a pending order, but I have two in the money credit spreads to fill. I'm looking to get out of this kind of dead zone trade for a couple of bucks. I got filled at 580 this morning. I'm trying to get out at 560, 550, 540, something like that on the day. If price goes a little bit lower, that would be pretty helpful. Okay. FOMC is at 1 p.m. Check your time zone, because it should be 2 p.m. Eastern time. If you go to today, minutes should be released at 2 p.m. 2 p.m. Eastern time. So yeah, they haven't dropped yet. Okay, safe haven demand, greed, junk bond demand, greed. So we have tight credit spreads, greed. I mean, this is interesting. Extreme greed, which as a slight contrarian, I get it that the market can possibly go into greedier territory. I get it. We can go greedier. But if you remember back in March and April when this thing was hitting extreme fear, that was the time to be a buyer. So if we're hitting extreme greed, I'm not saying it's a time to be a seller, but I'm saying it's a time to be managing risk, protecting some profit, maybe selling some extra premium. If things get called away at new highs, that's great. But I think a bigger, broader correction is good. I think that a market rotation or a broadening would maybe be done by a bit of a dip or a pullback, as opposed to everything catches up. The Russell still can play catch up. That's great. But I mean, I don't know. I mean, the market can do all sorts of stuff. I just think a pullback is needed. A little pullback is great. I do have a call condor trade running on the SPX right here. I'm down about $20, but I have a profit trap. By the end of August, if the S&P, the SPX is up above 6,500, I'm taking some heat on the trade. I'll lose about $800 max, but I can potentially make about $660 on the trade. I think realistically, I have about $390 of profit that between August and September. If the market shows me any type of correction, any type of 5 to 10% correction, that trade that offers up $3.90 is likely going to be trading for maybe $1.45 or better. And that's good, because I'll just take the 50% profit and move on. I'm not trying to hold this thing and call the top. If we have like a big flush down, maybe I try to take a little more out of that, but I probably won't. I think I just get a couple bucks out of it, I'll be happy. What does the Edge Finder have as far as puts though? I don't know. Let's take a look. As far as what put calls that I was talking about, like the put call ratio. Let's find out. All right, so Edge Finder's loading up here. And let's go to sentiment. Put call ratio. So we're showing what was, and this is really interesting, like because volatility is low, a lot of buyers on puts right now. Okay. I think that insurance is cheap. I still think that this is the more savvy investor that's just buying protection. What have we seen here with fear? I mean, the market tends to melt up. That's what's kind of crazy. It's like up here, the market still melts up. Up here, the market has been melting up. This is why we hit some highs. If this was down into more of the call territory, then I'd be kind of adding that into the fear and greed index with the CNN website, and probably being a bit more contrarian on like taking profits, selling some calls, certainly adding some puts and downside protection. So I think right now this is like a wait and see. Look, I'm tilted bullish. If the market keeps melting up, I will make more money. If you've been following us at all this year, my high for the year initially was like 190, and then it was 205, and then it was 240, and then it was 260. Now it's 325. It's like I'm making more money even as the market's melting up. I'm making more money. That's good. I'm not as active. I'm not as aggressive, but I'm making more money. So if this just positively drifts up to 400K, up to 450K, I'm still very happy with that. I'd like to make more, but I can't in good conscience kind of disobey my technicals and think like this is the time to buy. I don't know how much smart money gets thrown in at all-time highs. You know, I think the reality is smart money would be happy to buy the dip if we get one. Otherwise, I mean, if you're a mutual fund and your mandate is to be 90+% invested, you haven't had to do anything other than sit and hold. That's it, right? If you sit and hold, you're in positive territory, and all your mutual fund clients can be happy with lackluster returns and an expense ratio that's probably like, wait, I'm up 4% this year. That's it. I'm up 1% this year. I'm negative. In fact, there's actually a high majority of mutual funds and fixed income vehicles that are down for the year, even with this reflexive bounce back. So it just can be increasingly frustrating to, if you don't pay attention to the market and you're a passive investor, hey, my portfolio is up a couple percent. Cool. But did you hopefully hibernate during this like 60-day trade war? Because if you didn't and you're paying attention to it, it seems like, oh my God, what's going to happen to my money? Right? Because all of a sudden you get a 20% haircut by any type of major exposure. So anyway, my point is, how many large smart funds are sitting here at all-time highs just chasing all-time highs? I don't think very many, right? I get it that some are underperforming, but I think that a better level would be a little pullback here, which is what we've seen oftentimes when the market has a correction, goes back to all-time highs. There's usually some type of sideways move before we end up going higher. And that's what I would love to see. I'd love to see the market at least give us a flush. Like even after COVID, even the market recovery during COVID, we got back to highs 10% and 8% before the market started to propel higher in 2021. That's what I'd like to see. And the big question is like, as long as we don't take out, and I really mean this 5,700 zone is so critical that if we come back and test like the 50 period or the 200 period, I'm interested in taking some stabs at that to see if that is support. If we go below this, okay, if we go below 5,700, I don't know if we necessarily take out the lows, but this to me would look like we have a broadening pattern type setup, or we have some type of, I don't know, bigger wedge, and the market's going to struggle to take out recent highs. Okay. I mean, there's equilibrium. You can take a low here. You can take a high here. You can look at your big fib zones and see like, where would this market bounce? I see a lot of dynamic support at the moving averages. You can drag a fib from low to high. This area makes sense. But to me, technically, I want to see it, bounce in here and bounce up. If it closed below the 200, I want to close back above immediately, if possible, because that would show us like it's a really keen market to buy the dip. Okay. What I don't want to see is a flush, a little tiny dead cat bounce, and then another flush that breaks that 5,700 floor. If we break that floor, I mean, again, we better come up, but if we have another flush, like, oh boy, we might be in some, I don't know, this complacency, this euphoria, this buy the dip, everything. It's like maybe it's not. And maybe the market can't justify all-time highs. And that's got to be a reality we got to deal with. Do I think we take out the floor? I don't know. I think Trump and company now are so focused on growth and so focused on doing everything that's going to favor growth that they have pivoted so hard into this E-shaped recovery, this paradigm C, which is just fiscal spending plus the Fed's going to be cutting rates. That should be a good environment for higher stocks. It may not be better inflation. It may not be improvements to that 2% inflation target, but maybe they don't care because they can talk it right now. They can jawbone it. They can replace Jerome Powell next year and then get a yes man in the Fed to cut rates like crazy, run this market super, super hot to our next bubble, and we can have another crash, right? And what's crazy is we have had, I think since 2008, we've had like 11 corrections of over 20%. 11 corrections of over 20% since 2008. That's a lot, man. That is like, I mean, that's why I've been saying, like, since the great financial crisis, we've essentially had like boom and bust cycles for the last 15 to 16 years. It's pretty wild. The Fed should raise rates. I know, but are they going to, Ryan? Do you think they're going to raise rates? Like, Trump would lose his mind if the Fed raises rates in September or December. If they raise rates, Trump will go nuts. And again, he's not right. It's like, I just think that the reason they would raise rates is because global yields are still high, and we've been running at more of like a 4% a year inflation, not 2.5% that we're being told. So why would they raise rates? Because global bond yields are higher. So we don't have the room to cut rates. But I think we're like trying to thread the needle again. We're trying to hope that inflation does go down, that this trade war is going to be somehow increasing trade versus creating more friction. But it's like, why call a 50% tariff on copper all of a sudden? It's like we're talking about a blanket tariff of like 10%, but you're going to do something like isolated like copper at 50%. Like, why? What does that protect? That doesn't protect anything. That just makes everything more expensive. You buy a car, copper's in your car. You buy, batteries, anything EV related, you buy a house, copper's in everything. And I think the move that we just saw in copper is so distorted that it's probably going to be now a messed up price action. So anyway, meme stocks rallying isn't a new bull run. Yeah, that's true. When you start, I mean, I don't know if they're all meme stocks. I mean, SPACs are coming back a little bit, which is kind of concerning. I don't know. The end of times was like 2021 when you saw like NFTs and meme stocks and crypto. Like that was looking pretty nasty, and that's why I wasn't surprised in 2022 there was a massive deleveraging. But I mean, giving a meme stock that's up. Like, I wouldn't call Palantir a meme stock. It's popular. It was the best performing stock in 2024. But I just think that ultimately, like I showed this during like the halfway point presentation that Nick and I did. If you have a 22 times earnings, 23 times earnings, 24 times earnings, I mean, right now the S&P is around 22 times earnings. Right now the Nasdaq is around 27 times earnings. These aren't historically the highest, but they're at levels that we have to have brilliant earnings now to sustain these valuations. And that is why there's talk about more money going ex-US, more money going outside the US. That's why I'm in Brazil and Latin America. I'm trading the Japanese yen. I'm trading some non-US like China and Europe. I'm just out there with those as potential diversifiers, because in the US market, the reason I love the US market is because it is still the biggest and the most liquid market in the world. And the premiums we can take on some of these stocks that are high flyers or just high premium. MicroStrategy is high premium. Tesla is high premium. Apple is not so much high premium. Amazon's decent. Nvidia high premium. AVGO, Broadcom high premium. Palantir high premium. I mean, you can do a lot of good trading income wise with tons of liquidity in the U.S. markets. So as an income trader with a whatever it takes approach, up, down, sideways, the U.S. market is still my go-to. I mean, I'm not just a buy and hold, like I'll just allocate percentages and just let it sit. If I'm allocated percentages, I am absolutely trading options around those core positions to improve my cost basis. I have to, because it's too easy just to look and be like buy and hold and hope everything works out. Buy and hold and buy and hold and rebalance. Hope it all works out. If I can take my cost basis down, I mean, case in point is I was assigned some shares of the SPY at 589, and I now own that tranche of shares at 560. I own shares at Tesla at 255. I now own them at 220. MicroStrategy at $400. I now own it at I think like. Let me check. Let me check my brain. I was going to say low 300s. Let me check. MicroStrategy, MSTR. I own shares of MicroStrategy. So I have a 364 cost basis with a $400 call. I also have a 362 with a sell call at 385, and then I have a 247. I own the shares originally with $396 was my original buy price. I own the shares now for $247 because of options. If I just sat and bought and hold at 396, I'm break even on the stock. I mean, I've now worked it where it's like I have about $70 to $80 of upside, and I'm still selling premium to make more money as the price is sideways. So, yeah, again, a lot of ways to do it. I'm not saying my way is perfect, but I will continue to enjoy the melt up if we get it. I'll have this go to highs, and maybe if I can tap close to $400,000 this year without really having aggressive participation, I'd be pretty happy with that. Give me a dip that I can buy that the market can fall 5 or 10%. I can position for, and then get another big chunk of a chunk of a profit. Maybe I can poke that 400 plus mark. I'd love to get to 450 to 500K this year if possible. I think that'd be a pretty good gain considering what we kind of survived and had to go through with all the crazy uncertainty. But if we have a downside correction, I also have hedges that pay me 16 to 1 and 25 to 1 and 40 to 1. If we have an absolute implosion in the markets to the downside, I have 16 to 1 and 40 to 1 hedges that will cover my entire balance and probably still give me 20 to 25% of the year. So from that standpoint, like, I don't have to be aggressive. I don't need to be aggressive. I have downside protection if I need it. I want to participate strategically and not just chase. I think it's the worst feeling in the world for me. A trader that, I mean, are you often rewarded for buying highs? And in the stock market, the answer is yes, kind of, because what happens to all-time highs? It's usually followed by more all-time highs. Okay. But in an environment like this, where all-time highs have to be reached after such a big move, I think just a little bit of a ventilation goes a long ways. It doesn't have to be a bear market, man. It doesn't. It just has to be a pullback. But a little pullback, a little pause, anything to show this market has a sense of reality would be healthy. I think that's good to kind of have a summer slowdown. Maybe July is that slowdown. Maybe this market doesn't really pick up a lot of momentum and price action until we start to see the more exciting price action like Mag 7 earnings and the trade war deadline and non-farm and other stuff that trigger. And also summer trading can be a little bit lighter volume and things can move a little bit crazy. But by August, September, I would hope that there's some type of pullback. I just know that it never looks good. A pullback like this is going to be like led with all the reasons of why the market's going to go down. It's in a recession. It's like, is it though? I mean, we've climbed the wall of worry this far. So unless this is going to be like a 2007, 2008 fake out again, where it's like we hit all-time highs, now we're going to break the lows. I don't think it's that environment. I think that type of move is, I don't know, maybe it's years away. Yeah, maybe it's post-Trump. And as the famous saying goes, the markets can remain irrational longer than traders can remain solvent. So I'm not a crazy bear here. I'm not a crazy bull here. I have to be patient. That is honestly the hardest thing. The hardest thing to do right now is nothing. Okay. And that's not something I do often. Nothing is not in my vocabulary as a trader. I want to do something, but I just know that I can't put good, clean capital at all-time highs when I think that technically we're overbought on the daily, we're overbought on the weekly, we have divergence, we should have some pullbacks. We've never been or rarely been 300 plus points away from the 50-day moving average without a pullback. We've got 200 plus the 200-day moving average on gold is at 445 bars. We've got stocks that have ripped over 100% in the last 2 months of trading. That's insane. So just a little normal, a little reality. That's all I'm looking for. So we'll see. And if we have like vol suppression, then maybe the market doesn't go anywhere, right? And then we have like a vol event, and then it buys the dip, and off we go. I don't know. There can be an infinite amount of ways it plays out. I still think that the lows are safe. I think the market's going to try to get higher. I would say if I'm calling a bubble on this market, it's going to be at like 7,000 plus. I think if we rip up to 7,000 and it looks something like this, if I zoom out and we go all the way up here to 7,000 plus, okay, up and up and up and up and up to 7,000 plus, that type of move with a 60, 70% rally with essentially no pullbacks, I'm going to kind of call the top into like a 2026 move. And all I would do is I would just hedge out like 6 to 12 months, try to take something dirt cheap, get me like a 10, 20 to 1 return on investment, and just sit on the sidelines and wait for a correction. And I probably protect a lot of my profits along the way because I'd be pretty fearful that we have some type of pullback at least to the previous all-time highs. Okay. The integrity of this market is still bullish, 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 right? If we have this type of move, could we go up and come back down again? Yep, but it would still be bullish. Maybe this. Can you imagine that type of volatility for traders in the next couple of years? I don't think that's what it does. But as long as we don't break, I mean, I'm telling you, man, this 4,800 floor is so critical. Nothing good happens below 4,800. So if we breach these April lows, they better snap right back up above them, because that is a floor that you do not want to see break. But the market doesn't usually act that obedient. Usually if the market's up and everyone's excited and the markets are fine and complacent, then we'll just drift higher. And that melt up probably gets into a space where it's like, oh my God, it's crazy overbought. It's overbought on the daily and the weekly and the monthly, and it's diversion, right? And what's a correction? Probably move back down to previous highs and resistance. Maybe a dead cat bounce that goes ABC corrections, right? So an ABC correction, but we're not there yet. I'm not in bubble territory. I'm not saying this is a top we have to sell. I'm just hoping there is a dip to buy. Okay. So back to the daily chart. I mean, I'm just looking at not the 21-day moving average. I don't care about that one. I'm not buying the 21-day moving average. I'm buying the 50-day. I'm buying the 144. I'm buying the 200. I'll position for those dips. 1, 2, 3 dips. Because if those go back to highs again, yeah, we can range trade that. We can buy low. We can take some profit up here. If we have some choppiness, that's fine. You can still buy low. If we break the highs and melt up higher, that's fine. Easy money. But just give me a dip to buy. That's all I'm saying. All right, 25 minutes FOMC minutes. We'll see what happens. For the day, I'm still looking for price to maybe get down to the 62.30 level. That should help my little trade in SPX. I'm going to try to make about 50 to 60 bucks on that. Okay. Let me see. And again, if I can take some profit here, I hate to take like a tiny little profit, but it is here. Annoying. I mean, where are we trading at? 62.44. So I'm like 5 points in profit, but I'm only getting, I'm still in like a bit of a drawdown here by 30 bucks. I'm hoping we make at least a run down to like 62.30. Like the big sticky levels today, this is the big one at 62.30. We potentially have a 1+% move on the day, which if we fill the gap here, that's 0.669. If we go 1%, we're trading right around 62.05, which is right around the lows from Monday. So can we have a flush pullback and then another flush coming like later today? Maybe. I don't think the minutes are going to be like big news necessarily. I just don't want to see price come right back in this red box. So that's why I've got to be at least mindful to see what price action does. But let's find out. I suppose if price like rips to fresh highs in the day and fills the gap, then that's still a winner as long as we're above 62.65. Okay. All right. Gold. Let's talk about it. We did a lot of this stuff this morning. I did top down, A to Z currencies, futures market, gold, silver, Bitcoin, all the indexes. So just revisiting that stuff. The VIX is now below 16. I mean, this is fresh lows again. Like VIX is down 5% on the day. I get it. Like, I mean, one thing I was looking at on the VIX, and I don't know if this is the best timing for it, but if I went to like September, okay, either VIX or VXX. Okay, VXX is a little bit tougher to trade. VIX can certainly be tough to trade, but we're trading at 45.56 on the VXX. I wouldn't mind doing some type of vol play here. So if we get down to like 42.50, I wouldn't mind doing a vol play here on the VXX. And how do I play that? I might do an out of the money call. I might do a bull call spread, but I would say that like probably a 30 to 90 day expiration would give me enough of a window to, get paid on a spread. A spread can be tricky because also there's the time factor. Like if the VIX spikes so fast and then reverts, I can still lose on the trade. So the faster profit would be if we're down here, I look at maybe a spike into this area and try to buy like an out of the money, and maybe I pay $1 for that and it can trade for like $4, right? Like that's a good return. I don't want to pay an arm and a leg for it as a bit of a hedge. So I can vol hedge this thing if we come down to levels where I think we're going to end up spiking up. I just don't know, what's the VIX going to do ultimately? I mean, are we going to go down into the 14s and 13s again? Are we returning to some of these lower VIX levels? That this has been the big discussion with volatility kind of getting pinned at prices is we're not really going lower. And I think that's why if you saw this in the news this year, it's like, do we have a new volatility regime? Is this a new volatility regime? Is like higher lows on the VIX? Maybe it is. But if the VIX comes back down to these lows again, then it's not a new volatility regime, and we're coming back to these crazy levels, which the market melted up all through 2023 and 2024, right? But we did have a vol event, August, right? July, August 2024. Okay. All right. Bond volatility is down. SVXY keeps melting up. I bought this thing at like 35 bucks. I wish I still held it, but it is what it is. Dollar index still catching a bit of bid off the lows, oversold conditions. I'm just not selling the dollar. I keep reiterating that I'm not selling the dollar. Oil is hanging off these lows at 65. That's a pretty good support zone for right now. USO had a nice bounce as well. Natural gas down to 1408. I've got an expiration on my diagonal spread to keep selling. That's on Friday. I'll just keep lowering my cost base a little bit. CL, let me see what that one's doing right now. There's a little bit of time in this one still, so it's probably not showing anything good. I'm down 10 bucks. The price is hopefully it's a 1111, which is a little $500 trap and a $220 credit. So the idea is hopefully just pulling in, $200, $220 of profit. If I get a profit trap where we have some fresh lows in oil, then great. Maybe out of the move here. This is out to December. Let me flip this around. My move is down to 50 bucks. And so I'm getting like a 14 delta, 13 delta. I mean, I have about an 87% chance profit on the trade right now. And hopefully that's enough. Like we'll have lesser volatility. IV at 25.4. Hopefully we get out of some of the drama zones with oil, but you never know. I'm just trying to stay out of the way. So as long as oil stays above 50 bucks, I've got some income coming my way. Gold. I'm a broken record here. You can't convince me to buy gold at $3,300. You can convince me to buy gold at 31 and 3,000. Down here, I'll wait all day. And I get it. This might go up. This might go up. I'm still going to watch those moving averages. You can put them on your charts. This is a 144 EMA. That's an exponential moving average, 144 period on the daily chart. This is a 200 exponential moving average. I want to buy dips at these levels. And you might be asking, well, how is gold going to drop? I don't know. I don't know. I don't care what the reason is. I don't care why gold's going to drop. I just think the technicals mean we've got a 6 to roughly 9% correction in gold. I hope we get it. If we don't get it, then all this is a postured bullish market that's going to allow these things to catch up. We maybe have like a fake out to the downside and then it rips higher. I think that this dynamically will still offer a support zone. I'm just going to be patient enough to wait for it. And I hate it. I really hate it. Like I'd love to be like, gold's going to $4,000 an ounce. Let's get into it. But if I can buy it at 31 or 3,000 versus 3,300, I'm going to take that discount. So that's what I'm kind of patiently waiting for. Silver, as I've been saying, I like silver better. Silver technically is a much cleaner trade for me. Technically, I can see the bull flag. Technically, I can see the bull trend. I can see the measure moves, all-time highs all the way up here. I like that I can see the target on silver. Gold is wishful thinking. Highs on gold, cool to wear. Measured moves say what? I don't know. Gold can go wherever it wants, but I don't have any more measured moves that I'm really that keen on. I have consolidation. I can go back and say, okay, we've had a 5-wave move. We can go here on gold. Say this is a 1, 2, 3, 4, 5. Okay, so what are we doing? Well, we're just consolidating. So we can still continue this trend, but to what measured move? If we hit this level, that's 3,500. We hit it. So my next level, I suppose, would be, I guess we have this swing here. So that swing, I don't even think that's right. Let me go monthly. So swing 1, 2. I guess there. So that low from November of 2022 to this current high, that's my next swing. A pullback, like I said, around these daily moving averages, even a fib level, 3,000 would be great. 2,700 would be amazing. The nice thing is even with this, I could confidently project that, okay, silver can hit a technical 4,000 or 4,600. But I think we have to have some type of pullback first to allow for this accumulation to take place. Then we start pushing up into 3,800 to 4,000. Maybe that's the next big profit target. 4,000 is a round number, right? So that's the plan. Is if we get a pullback to 31 or 3,000, my goal is to get to 4,000. We clear 4,000, let's go to 4,600. Let's go to frickin' the moon. But at that time, if silver can outperform and get to all-time highs, I'd be really loving that trade too. Okay, Bitcoin at 109. Bitcoin at 109. Do we break all-time highs with some conviction? Maybe. I mean, this big beautiful bill, the OBBBA, one big beautiful bill act. I mean, it's something like $3 trillion getting added to the deficits, maybe more over the next 10 years. It's essentially an extended tax cut for the wealthy and corporations. It's disrupting like energy. It's I don't know. It has its pros and cons. I think that the approval rating for Trump has dipped a little bit because of it. People are way more aware of the fiscal cliff in the U.S. and the debt problem, but the whole world is in it, so it's not enough to really derail the markets right now. But anyway, Bitcoin is potentially that like fiat system hedge. So I mean, bill goes into place, Fed cuts rates, makes fixed income less attractive. Bitcoin maybe catches a nod or a bid. Bitcoin is still something that looks like we have to have the Qs running higher and the Nasdaq and money flows running higher. It's still a risk asset, just less volatility now. What up, Nick?
What's up, Chris? How's it going, man?
Good, dude. How are you?
I'm good. I wanted to ask your thoughts on my conversation earlier. I think you heard a little bit of it. We've done this streaming thing back and forth together off and on. We always kind of check in.
Yeah.
I'm curious your thoughts right now. With a market that's hitting fresh all-time highs and with a VIX that has gone from 60 to 16, are you feeling like, okay, I'm going to keep riding this thing, I'm going to keep adding longs on pullbacks, or are you more in a defensive posture? I mean, I guess like when you get a VIX into the 16s, I immediately get a lot less interested in selling for premium. I get a lot less, the risk to reward on equities and on indices just becomes a lot less attractive. And so the stuff I'm in, I'm just trailing stops and selling covered calls. And I mean, I'm fully invested right now. I have like all my cash is in stuff.
Okay.
But I'm just curious, what are you thinking right now with that?
I definitely have cash on the sidelines. I'm not bearish, but I can't bring myself to participate at these all-time highs. I am melting up with it. I am drifting higher with it. I have, core positions 1, 2, 3, 4, 5, 6, 7. There's probably 10 tickers that I own stock, and I'm just selling covered calls and I'm rolling covered calls, and that's helping me probably generate an extra, I don't know, probably close to like 10K a month. If price just goes nowhere, like I'll generate about $10,000 a month, which is fine. So I still have some more gains to look at for the end of the year, which is safe. I have downside protection in case the market just loses its mind. But what I would love to see, Nick, is just a little bit of a pullback, dude. I mean, I want to see a pullback to like the 50 moving average. I think this market is incredibly well supported around this 57.50 zone. So we can pull back to 21 period is very shallow. 50 period is right there where I think we at least have to have a pullback to it. And this could be a pullback to the 50, a dead cat bounce, one more flush lower. Wait, I'm ready to go long again. I love that. Maybe I'm spot on, but it's like, that's roughly my plan, which is, the market doesn't move in a straight line. And so even a flush down here that shows like the dip, I think that market maybe comes one more time. And that's where I'd rather position for, let's get back to the highs again. That could be a double-digit gain right there.
Yeah, I mean, see, that's the thing is that's, to me, if we were to get sideways, or in that case, I mean, what sideways truly is, like you get down and you get up. So we just haven't had any down. So if we're going to trade sideways for a couple months, I think the way you would get that is you would get, a move like what you're talking about, something lower here. And I think that, you've got the S&P 500 at a 23 multiple. So you're talking about an expensive market, which doesn't mean it has to go down, but it does suggest that, okay, your risk to reward here, and that's my big thing, is this is all risk to reward, always. We never, if you listen to Chris and I talk for the audience members, like you're never going to hear us like with certainty thinking, gold's going to do this, Nasdaq's going to do this. It's always risk to reward. And so to me, you look at a market like this and you say, okay, this felt like way too similar to COVID. And we know how COVID kind of part 2 went. The thing just melted up for another year. Are we going to see that environment? Man, I don't know. But I feel like,
I think it's hard. I think it's hard to do that round 2. I really
I
think it's hard to
agree.
do that for a second go of like, I mean, COVID was the whole world put in $6 trillion. This is, well, we're putting in another 3 trillion over 10 years, but it's like, is the whole world going to benefit from this type of move? It's like, we have a trade war, we've got a Fed, we've got higher interest rates, like everything is different. So
yeah, I think that was the
it's a great recovery.
contingency.
It's just not the same. It's not the same at all. And these valuations, I think, are quite high. The Mag 7 still remains higher. I think that the shoe to drop, if we're going to have a correction, I really think it's going to be somehow the market has to be disappointed in earnings. I think that's the
Yeah.
only thing that's really going to make any sense, unless this whole like
the
now
only
until
thing.
August 1st, if Trump like comes out swinging with something totally off base, like one is the 30th of July, and Powell's like, you know what, we're not going to cut for 2020. Like, and this is extreme stuff, but if Powell's like, we're not going to cut, and Jerome Powell and Trump like have a little, you know, it's just Trump. It's like Powell doesn't say anything, but it's just Trump. But if somehow he just like, if Trump just gets more angry, more wild card, it's like maybe he affects the market. But I think the market likes to mute him now. The market likes to ignore a bit of the noise that Trump has created. The market now is probably more focused in on, okay, breadth is still pretty bad right now. And we're hitting some extended conditions that we don't typically see. And earnings season at a 22, 23 times multiple, at a Nasdaq 27 times multiple, we have to have like freaking stellar earnings, because if we don't, then these valuations are going to be adjusted, and that adjustment can be really aggressive, and that adjustment can be really subtle, and you never really know. But I still think that a buy the dip is probably in play for 2025. I'm really not a bear, Nick, until we have like true like bubble type technicals. Like to me, we'd have to run up to like 7,000 or so with no real pullbacks, and I'm just going to be annoyed that I didn't participate for the next 800 points. But if we run up there, like I'm a bear at 7,000, I think I'll turn into a bit of a hedger, you know?
Let me, you made some good points there. And while you did that, I prepped a chart for us.
Okay.
So this is the stock box, still very much in dev mode. But one of the things that you pointed out just a second ago, that is, you know, at the end of the day, you point to a market which is actually experiencing the big players at the table who are taking the lion's shares of earnings per share growth. Talk about Meta, Amazon, Apple, or maybe not Apple, but yes. I mean, all these companies, the big ones, if they start missing earnings, then I think you actually can point at and say that is a sustainable reason why stocks can trend lower. At the end of the day, right? If you're going to look at the indices, Nasdaq, Russell, S&P, Dow Jones, whatever, we have all this noise. Trump says this, market goes crazy. At the end of the day, the number one thing I would say that the stock market, the indices at the index level, what they follow is earnings per share growth. And the thing is, as you pointed out, through all of this chaos, all of this craziness, all the earnings per share, I have an earnings report tracker. 4 out of the last 4, Microsoft have beat their estimates handily. And we can go down the list. I mean, we don't even, you pick your favorite of the big 7 for the most part, other than Tesla and Apple. You've had these dominant earnings reports that have just been a theme. It's like every time this market throws something at it, tariff worries are going to kill earnings per share, Google comes out and swings huge for the fences, right? So you have all these earnings per share actual numbers that have beat estimates. That's why I actually think where we've seen we saw a huge surprise, and this is really what I want to set up for Q2 earnings, which are starting pretty soon for the indices. Mm-hmm. Q1 expectations were in the dumpster for earnings. Yeah. People were like, companies are going to put up terrible earnings, and it's going to be kicking us off into a bear market. What we actually got was pretty solid numbers, and the stock market ate it up, right? It just ripped. But now you don't have that same luxury of low expectations going into earnings. You're right back into high expectations for key players like Google, Microsoft, Meta, all these big players. And I think those are obviously the ones that just matter the most. They're the biggest in the S&P. Those earnings, if they do not absolutely, knock it out of the park again, then we could be in trouble. So I just think that at the end of the day, you really want to point to a sustained down period that does not just get bought up right away.
Mhm.
It's got to materialize in the earnings per share estimates getting missed.
Yeah, and that takes a while because the S&P earnings estimates are still predicting higher earnings, all-time highs, and I think it's the severity of those of those changes, of those alterations, that would be how the market quickly prices in something bad.
Yes.
You know, like summertime can be tricky. I mean, last summer it was the Bank of Japan, the deleveraging was given the reason for why the market dropped. I think it was due anyway. It's like we had a little hiccup in April last year. We had a little hiccup in July, and that little hiccup rolled into like the deleveraging, Somro activated deleveraging over the weekend. It showed like true vulnerability over the markets for the weekends. But it got picked right up in that August 5th bottom, and it ripped up, and it had a little hiccup during Labor Day, and it went to all-time highs like past September, October, and then we had a huge bump on the election. It's just like it's the same stuff, man. It's just up, down, up, down. A sustained downward move is going to have to be like, I feel like all hell has to break loose for a downward move that's going to be sustained. I mean, and I would say that if Trump was still 2 feet on the gas of a trade war, then yeah, man, let's go to fresh lows, and let's like just cleanse this market like crazy. But that pivot that disrupted the bond market, April 7th to April 9th, like that window right there, now Trump is pro-growth everything. Now this big, beautiful bill is pro-growth everything.
I mean, it's just a giant stimulus package, right?
Fiscal policy has been the reason the markets have, like, this is why Biden was given so much crap as a puppet president, because they just spent a ton of money. Fiscal policy is what kept the markets heated and running.
Yeah,
and
it's
it was
more
good.
stimulus.
It was good for investors, but terrible for Main Street. But Trump is no different right now. Like, we are literally we're stimulating again. It's extending tax credits. And whether you have pros and cons to it, it's like there's some ugly stuff in 1,000 pages, as there always will be. But for the most part, it's still the government is willing to spend and run a deficit, and we're hoping we can grow our way through it. And that's a huge if. And right now, the markets can still like lean on the optics of growing and having the narrative and the policy be like shifted towards growing. But it's if we disappoint, though, it could be like the growth shock, right? As we want to grow, but we truly have all these restrictions and headwinds that shows that we can't actually grow. And that hasn't set in yet. That reality has not been set in. So that's what I think would be like the big turning point, is if we're like, man, we want to grow, but we freaking can't because yields are too high, costs are too high, labor's maybe struggling, whatever, people are pissed. I don't know, but we're not there yet where the optics are being priced in.
And Chris, one thing I want to just add on to that is, I think part of the reason we've had such a resilient market throughout this whole period of time, right? For everybody who's listening, obviously we've seen a crazy couple of years, but there's one thing that has been consistent that I think has kept earnings per share looking pretty solid for this whole time, right? We just got done discussing the importance of companies putting up good earnings. Here's your reason, right? This is your reason, I would say, as to why companies have continued to do okay. You're looking at unemployment rate over the last 5 years. January of 2020, we were at 3.6% unemployment rate. Obviously, U.S. alongside most nations across the world experienced huge unemployment spikes that shocked short term and then mediated or moderated over the next few years. The reason things have stayed relatively stable for stocks during this period of time, yes, you've had your big pops and drops and scares and stuff. People have stayed employed. That's why they're still able to go out and spend money and do okay. And so for me, I think if you want to talk about a sustained bear market, keep your eye on unemployment rate, because once that actually, and again, nobody knows with certainty when this is going to start trending up, but at some point, right? And I'm not betting on that, right? So I'm not making a bet that I think unemployment rate is going to spike. But when it does, to me, that would be a signal that sustained bear market status could actually take place. But right now, as long as you have stable unemployment and inflation that's not super threatening, and to your point, Chris, the big, beautiful bill, right? Maybe it's not good for Main Street, but in terms of the stock market, right, they love the idea of just fiscal stimulus getting piled on and more spending, which stimulates stocks. So again, it's kind of a weird thing, but you kind of just have to, put your glasses on, narrow your gaze a little bit, just say, look, stimulus plus unemployment rate. This is not a market I can bet against. It's not necessarily something I want to chase off a cliff, but we both kind of expressed our, our policy, which we've said many times on the stream, which is that cautionary optimism around stock indices, et cetera. Just quick plug, by the way, if anybody enjoys the Edge Finder, Stock Box, all of our tools, everything is 45% off right now. If you want some information about that, we'll drop a link here in the chat if you want to speak with a representative on our team about getting a copy of our tools. Like I said, everything is 45% off, biggest discount that we do all year long. There's the link. But yeah, I mean, Chris, what are your thoughts on that? Would unemployment rate be a key thing to kind of keep an eye on if you want to talk about true earnings per share decline for the S&P at some point in the future?
The best leading indicator that I have for every recession is residential construction jobs.
Yeah.
It's the best leading indicator that's been, if you have consecutive months decline in residential jobs or residential construction jobs, that has been the preview ahead of every recession we've had for the last 30 years. So
it's a really good one.
That's one thing I want to watch, and it's not there yet. And honestly, home builders are going to hoard because right now we're still in the supply catch-up phase, right? So, why I think the market is still relatively healthy and stable is because we're still building homes. Like, dude, I built in a brand new neighborhood here. We have, I don't know, I'd say 20 or 30 more units that are going in before this phase is completed. And then there's more and there's more and there's more. And I mean, I see the teams come in every single day doing all this work. Like, they're not going to fire these people now. They're going to build until all of a sudden it hits them where it's like, holy crap, nobody's buying houses right now. And then we have a complete freeze at the housing market. So we're talking like that type of leading indicator could be 6 to 12 to 24 months away when the consumer finally breaks. Because as we've seen this year, with very few stocks that can lead the market to all-time highs and wealthy consumers that can still buy for everybody else. The top 20 consumers can handle 60, 70, 80% of the consumption. It's insane, like how the wealth disparity has created this. And we've got baby boomers that are near retirement age and they have crap tons of money. And what do they do with it? I mean, maybe they pull it out of the markets a little bit for less risk, but who knows, man? I mean, all these things are these are big, big, big macro themes that could take months and months and months to actually matter, where it's going to be like, oh, now this bad stuff is going to get priced in. Like these could be months away. So I think it's potentially the growth shock of, oh my gosh, the US wants to grow, but it can't. The trade war thing could maybe spike up a little bit. Like in these next, 3 weeks, if basically the Eurozone says, look, we're not going to ink this, or I don't know, if there's any type of I don't know. It just seems like there's more fighting. We just, nobody falls in line. We're being told by Bessent and Trump, like, trade deals are coming, but here it is July 31st or August 1st. And what trade deals? What's happening? Is anybody? I mean, I don't know, because if we just write a letter to every country and said 10% tariffs, is that a trade deal or is that just a global tariff? Wall Street was ready for a 10% trade war, but we escalated it to the dumbest rollout with 40% here, and we're tariffing Penguin Islands and all this other stupid crap that then pivoted into something totally different. So I still think there's going to be a lot of spin on however this plays out. I think that's why the market doesn't care about it right now, and it's going to be either the reality of the growth shock that we truly can't grow away like we say we want to, but with government policy, spending, and all of the deregulation, what this bill was the government's going to spend and the government's going to deregulate in order to promote growth. That is a boon for stocks. Right. That is good for the stock market. And this is not something you want to fade. And the hardest part, Nick, is it might feel like the whole time you and I might be having this conversation multiple times over the next 6 months, and it's like cautious, 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 cautious. And that's okay, because cautious can still make us money. Cautious can help these markets up. We can still see 20+% 2023, 20+% 2024. We can still get to 10, 15% in 2025. We maybe get more because this big, beautiful bill rolled out. Maybe we get more, but maybe not. And so it's until price suggests holy crap, let's pay attention to this. I think that's the hard part, is I want to wait, but I'm telling you, man, every single day, it's my patience is tested where I'm am I really going to get a pullback to gold at 3,100 or 3,000? Am I going to get a pullback on the S&P 5 or 10% so I can buy more? Maybe I don't get it. And that's the Peter Lynch quote, more people, lose money waiting for correction than actually getting the correction. It's I just got cash on the sidelines. I'm fine, but It's annoying. Like, it's annoying to
It
think
is.
like I can't buy all-time highs. The market might melt up, but it would make some more sense to me to have a bit of a dip. That's it, man.
Yep.
Just a dip.
And Chris, just to jump in here on the FOMC stuff that just dropped here, I am getting some headlines I wanted to read out. Fed from the Fed minutes, several participants said the Fed funds rate may not be far above its neutral rate. That's a little bit hawkish. Fed staff says that, or the Fed staff saw higher real GDP growth for 2025 than in the previous forecast, which is a positive, and saw inflation lower than the prior forecast, also a positive. I've got the Russell pulled up on my screen here. If we could just switch that over. Russell here up 0.9% now on the day. Stocks responding positively here so far to this. Gold also liking, obviously, the idea of the prospect of lower inflation estimates. A little bit of a muted response from gold because you also had higher GDP growth. That's a little bit negative for gold, but definitely a slightly positive lean in terms of the meeting minutes here for stocks. Nothing huge, but you can see it on the lower time frames. We've drifted higher into this and continue to push higher, taking out today's highs on the Russell currently. I'm long the Russell, Chris. That's why my bias is there right now. But S&P, Nasdaq also doing quite well. Chris, I'm also long the DAX. The DAX has been just a surprising. I liked that trade in the beginning of the year, and it was one of those, like you've just got done talking, I completely, there was no pullback for me to be a part of this. And then when it did pull back, it pulled back sharply, and now it's just done a complete, I mean, look at the DAX, right? So we're just back to all-time highs in the S&P. Yes, S&P 500 has been resilient, but holy crap, look at some of the international stocks out there. Yeah, DAX has just been a winner. I wanted in on that train, so I bought in on that pullback, which has been okay.
No, that was great. That was a great play. And that's why I did like the non-US allocation this year. Was like US is great, and I mean I'll generate the income on the US side. Participate. Like I bought the lows in April, pretty close to it on the SPY and the Qs. But the DAX has been good. The FTSE's been good. China's been good. My little surprise play has been the emerging market stuff like Brazil and Latin America. They're up like 20+% for a year to date, and also they were sitting at like COVID lows. So if there's upside there with like cheap valuations, let's go non-US, let's go emerging markets. And I don't sell a lot of options on those positions. It's just there's a dollar allocation to it, and there's potentially outperformance. Like maybe Brazil does. I mean, Argentina did like 80% on their ETF. So there's potentially like huge gains. It's just I don't know how long they last, and I don't know what that gain looks like outside of you just buy and hold it. And it's not a huge allocation.
Exactly.
But yeah, the DAX is doing great and probably will continue to do so because Europe is also spending money.
Yeah, more headlines here. A couple of participants noted they would be open to considering a rate cut as soon as the July meeting if data evolves as they expect.
Yep.
And then another one here to kind of cancel that dovishness out. We've got some participants said the most likely appropriate path would involve no rate cuts in 2025. Those participants cited recent elevated inflation readings, elevated business and consumer inflation expectations, and ongoing economic resilience. What's interesting about the Fed right now is it actually seems like there's a divide in the Fed. There is a really interesting kind of division of, and there's a conspiracy theory that could go in all this. Do some of them want the new job when Chairman Powell is put out of a job? That's the and I say that not he's coming to the end of his term, not necessarily Trump kicking him out, but there is some claims that some of the more Trump favorable members, like Waller, for example, is a name that keeps getting thrown around as a possible new chairman who would be way more willing to kind of do Trump's bidding in terms of the rate cuts that he wants so badly. So,
but it's not a good thing.
Fed
office is not a
could
good
it
thing.
lead us into, Chris, could we be getting this thing that we've talked about for a while, the final phase of that kind of melt up truly, right? Where you get mass rate cuts, tons of fiscal stimulus, and then to tail it all in. And again, this is just playing around with an idea, but it's plausible. All of that leads to massive national debt kind of implosion. Who knows? It's been going on for a long time, so I'm not going to try and call or time the national debt theme, but indices definitely still liking this. You've got taking a look at Russell here up 1%, Dow Jones up 0.5%, Nasdaq up 0.5%, gold up 0.3 here. Pretty strong push overall for the commodities. Taking a look at the indices, oil prices are up a little bit. Bitcoin's up. Ethereum's up, making a push. Yields are actually lower on this. So seems like the market is taking this as a bit of a more dovish meeting minutes. So, and for people, I saw a couple people in the question wondering, or in the stream chat questioning or wondering, why aren't we pulling up Powell speaking? He's not speaking right now. The Fed meeting minutes are just essentially scribe notes from a meeting that happened behind closed doors. So he's not going to be speaking. We're not going to watch anything because Powell's not speaking right now.
Yeah, that one comment that said most likely appropriate path would involve no rate cuts.
Yeah.
I mean, I think truly no rate cuts would be the smart thing to do. So we don't. I think if you want like stable and less disruption, don't cut rates. Don't cut rates, because if we cut rates in 2025 and the bond market reacts like it did last year and goes up, if yields go higher, I don't think that's good. It wasn't good last year. The Fed got a lot of criticism for that 50 basis points cut. I think that's the argument that this year it's like if they don't cut in July, they're going to cut more in September. They're going to miss their window. They're going to block. It's like they never do anything right. But at the same time, they have backstopped the market for the last 30 years, Nick, and they've done a pretty good job by letting everybody that buys the dip get paid. So you can hate on the Fed all you want, but if you just buy the dips, you're doing okay, and just let the Fed be the Fed. I think it's crazy how critical we are on them and how transparent they're supposed to be. It makes it more and more difficult to let them do anything. It's like they back themselves into a corner. They're supposed to be so transparent. They're supposed to give exactly how many cuts they're going to do, and do they do it, do they don't. And it's like we watch this stuff all the time, and it's like it also changes. I mean, we started this year expecting how many cuts? 1. And now we had up to 3. Now it's back to 2. Again, at the end of the day, what happens by September to December, we'll find out. Probably 1 to 2 cuts, as it says right now on the watch tool. But if they don't cut in July, which they're not supposed to, it's supposed to be like a 95% pause right now. But if they don't cut in July and they don't cut for whatever reason in September, is that also a, is that like a bad event for the market to be like, oh my God, they're not cutting? What does that mean? I mean, from inflation, it should be good. Like tame inflation and keep it low, as opposed to, that's what I'm saying, like a yes man in the Fed chair next year that cuts rates, and all of a sudden we have a second wave of inflation that gets to 4, 5, 6%. I mean, look, man, it costs $10 to get a coffee somewhere. We were joking today, like the spicy McMuffin is a new thing at McDonald's. I mean, if you go to McDonald's and get a combo meal, isn't it like $15 or $20 now? Where it used to be like, what happened to the dollar
cheap.
value meal? I mean, like shit's expensive. And if we go higher, like this is what the Fed's job should be more focused on, is don't let inflation be this painful hidden tax that everyone feels and everyone is hypersensitive to. Because if you get inflation too high, like people will just stop spending because you can't, you feel it every day. You feel it at the grocery store. You feel it at the gas pumps. You feel it for your utility bills. You feel it for everything you're spending money on. It's like, it's at the point where 5 years post-COVID, it's like people are way more sensitive now to inflation. So I just think it's silly if we stoke it again.
The thing too that makes it challenging is that NFP report. Just a quick recap for everybody who didn't kind of factor that in or didn't look at NFP on Friday. I mean, we're at 4.1% unemployment rate. We ticked lower, right? So unemployment rate is not rising. We've got solid employment in the United States. Job openings also jumped for the first time for the last 2 in a row. We've had 2 higher prints on job openings. And then you want to talk about the NFP report. Jobs numbers came in higher than expected by 36,000 jobs, and they revised the previous number up, right? So you have a Fed that's now in a situation. And again, I want to be fair. Before the NFP report, I was in the camp of thinking, hey, maybe July is not so bad if you get a bad NFP report. After getting a solid NFP report, I think 1 to 2 is a fair consensus. I'd lean a little bit more close to 2, but it depends what everything comes in. And this is why it's so hard and why the Fed has such a difficult job, and why I am personally a big supporter of having a true, as close as you can get it, third-party, nonpartisan Fed chair, because it's important. Because at the end of the day, in an administration, it's just human nature to want to make yourself look as good as possible. And every politician wants to cut interest rates because it makes them look good, right? It makes free money for everyone. Everybody loves that. It makes everybody feel good, look good, etc. And I don't necessarily think that that's always the right thing to do. I do think that the Fed can cut interest rates this year. I think that we are, restrictive enough. And you saw it in the meeting minutes. They still think they're restrictive. So they have room to come down a little bit. But I don't think it's a good thing. I heard you talking about negative interest rates earlier. I don't think we should be setting the bar back down to where it was before COVID. We need to, go back to longer term averages and keep interest rates at a stable level, but not at a free money level, which also promotes bubble territory, right? So if you're going to avoid national debt blow up, this big, beautiful bill, it's a big bet on massive economic growth. That is the only way in this bill that it works, where you don't blow up, is that you have a huge economic boom to outgrow the national debt that we're going to pile on with it. And it's a theory, right? Could it work? Maybe. We'll see. I'm not the president. I'm not a, 5-star economist that can tell you what's going to happen there. And I don't think anybody really truly can for sure. But it's a big bet. And I think stocks are a clear winner in it personally, because again, it's just a lot of money that gets funneled to corporations.
Sure. And that's honestly the nature of the whole thing is, you pivot on the trade war, you pass this bill. You have, honestly, it's probably a good thing that the Republicans have the majority, because the 215 to 214 House pass is like barely getting the job done. Senate had the majority, so that wasn't the issue. But it's like, it just kind of showed politicians will vote to keep themselves in office. So what do? They pass it because it's the best thing for the country right now. It's the best thing to keep stocks higher. What I would say would be kind of an ideal situation is we should still offer. If we can create a lower inflation environment, so you can still have savers get rewarded. I feel like, that's the acronym TINA, there is no alternative. It's like you have to be invested in order just to break even. The debasement, the loss of purchasing power, the money supply, all these things are like, that's why the stock market is up. If you take the S&P compared to gold, the S&P compared to Bitcoin, it's down because those assets have gone up better. They've appreciated better than the S&P. The dollar is one of the worst starts in 30 plus years. So I think it'd be nice to have like fixed income that can still do, somewhere between like maybe 3.5% to 5.5%, somewhere in that region, but also still have tamed inflation where if you wanted to be risk off in the market and have a 4 to 5% yield, you can still be okay. You can still like preserve your capital or grow your capital in a safe, risk-free way. But I don't know if we have that environment, Nick. I think
and you and I, Chris, have been skeptical about U.S. bonds in general. You and I have had this conversation 15,000 times about how we both kind of prefer gold over TLT, and which has been the right call.
Swan. That's the other. That's the other potential. Like, if it's black swan, we don't even know what it is. But that's the other potential. Like the growth shock or something happens in the bond market where, I don't know, this 9-month outlook on short-term treasuries, these bond auctions are really disruptive, like long-term pricing. Bond yields ultimately would tell us like where it wants to go. I would hope that the U.S. doesn't have like a major crash. I would hope the U.S. bond market doesn't have. If you look at TLT, this is what's crazy. I think we talked about it this morning, or maybe I talked about this yesterday in an afternoon session. But TLT on a weekly chart, the feed here, this is a monthly chart, goes back to 2002. Okay, the lows are $81. We're not that far away from 20 plus year lows on TLT. So in a way, it's like it kind of makes it a bargain based on the chart. But what if that's not the floor? What if there's no guarantee or any reason for 80 to be a big level? What if it doesn't matter? What if it's like, so it's, again, if you look at that as, hey, I'm going to buy TLT at $80 or $81 and sit and hold it, it could be a great trade. But the trade-off would be that's a risk-off trade that maybe is the best bond trade of your career, but the equities market might be the inverse of that. If bonds go up 10, 20% and finally have a bull market for the first time in 5 years, equities market does what? The opposite? Do we have the equities market down 10, 20%? And they have an L-shaped recovery, which is you go straight down and then bottom out in a huge trough, and we don't just bounce back with a V. I don't love bonds enough to say like that's a trade I want to take, because if I did that, I think the only way I participate in TLT would be like through freaking spreads. There's no way I would trust I could just hold TLT and think it's going to be a great investment.
Sure.
I just don't trust it. So I still think that the U.S. is like the biggest liquid, bank of the world, which I agree with. But but it doesn't mean that the world's not trying to change it. Doesn't mean there's not wrinkles in the Fed's dominance. And I don't know. I mean, we can paint. This is why I said earlier in the week, like if you just make a T chart of like pros and cons, the negative side to me is starting to stack up a lot more than the positive side.
Mhm.
But again, that's not enough to turn the market. Not yet.
Right.
So I just kind of sit and wait, and I'm still patient, and that's the hardest thing to do. I think that, as we said earlier, the simplest way to approach this right now is what is price telling you to do? The U.S. is spending money, Europe is spending money, China is spending money, global supply is up. It's a boon for stocks. It's supportive for the overall economy. The trade war isn't nearly as bad as people thought it was. That's why we pivoted so hard in April. So there's still positive momentum that all-time highs usually are led by more all-time highs, because once we're there, what's easier? Just keep going higher. Just keep
Right.
going higher.
Well, and
Right?
that's the thing, Chris, is I want to kind of express that to the audience. You and I are going back and forth, but we've done this a long time. So for people who are newer to the stream, Chris and I, we are outlining all these sorts of risks, and you may hear like bearishness in what we're saying, but that's not at all exactly. I know based on our conversation here where we're truly positioned, right? So just because you may have something to worry about or some concerns, as you just described with the T chart, right? You may be adding on to your list of concerns about the market. That doesn't necessarily mean you're short the market heavily and you think it's going to go down. And, we've both been kind of on the right side overall in terms of having long exposure to these markets. But again, it's all about risk to reward. And so when the time is right to be with the trend, you stay with the trend, but it's also worth being cautious and also kind of optimistic at the same time. It's an expression that we say frequently because when the markets are trending up, it's very hard to try and fight that. Whether it's gold, same thing, right? When gold really wants to trend higher, good luck trying to call the top on gold when it just wants to grind and grind and grind. It's very difficult trade to do. But it doesn't mean you can't start to poke holes in your reasoning if you're still in the trade and say, hey, you know what? Risk to reward no longer is there. I need to bank profits, trail a stop, take partials, do covered calls, whatever you do, right? However you choose to manage your risk, however you portfolio approach what you're doing, it is worth being prudent as a trader, as an investor, to not be the guy. A lot of people who are here right now probably experience the 2021 craziness where, everybody got so excited. They had stimulus checks in their pocket here in the US, and they were throwing it at stocks and NFTs and cryptos. And a lot of people got really hurt during that time. That's in my opinion, the exact wrong thing to do in a market that is starting to trend up, is not to try and one up the market's perception, but to kind of always be slightly contrarian to what the market's thinking. Tends to put me on the right side more often than the wrong. So over the longer term. So I can be wrong in the meantime, but when I look at gold, path of least resistance is to the upside for me on gold. Same thing with the Nasdaq, same thing with the Dow, but it doesn't mean that I am going right here and I'm saying this thing's going up and I'm going to go buy calls on everything. That's not cautious optimism. That's euphoric, overzealous, all in approach. Chris and I talked about earlier in the show when looking at these indices, talking about, okay, bullish, but only interested. I'll drop my line in the water if we start getting a pullback to 5,900, 5,800, or something a little bit more prudent. When everybody starts to freak out again, okay, now the risk to reward comes back in.
Agree. And I mean, from that low to high there, I mean, if you just drag a simple Fibonacci, and I know we talked about the 5-wave structure. I mean, if all it is one giant move, it's like, okay, give us a pullback, right? 23%, 38% doesn't have to be like it doesn't have to be mind-blowingly bearish. It's just like, give us
that's 9%.
Exactly.
Yeah.
So like a single digit pullback, which by the way, 10% pullbacks happen every like 1.6 years. We had one last year. We're a year into this. We could probably have another one. We had a 20% correction this year that happens every 2.5 to 3 years. I mean, this is real trading. Like this is real history. It's like we're going to get a 1% pullback happens 100% of the time. Okay, how about a 5% correction? Like 60 to 70% of the time. Like it's very likely that 5 to 10% is within a perfectly normal pullback.
Yeah.
But as well as I do that if we pull back 9 or 10%, Nick, the whole news cycle is going to be like, what's wrong and what's going on and why is it happening? And it's noise, but man, it's just an attention grabber.
Well, and
So
that's why truly, Chris, it is actually so hard to buy low, sell high. It is hard to
know.
buy low and sell
Yeah.
high because when it's low, the market, everyone around you, the headlines, they
It's
tell
like
you
the
it's
world
going
is
much
ending
lower.
when things are
Yeah.
going down.
Yes.
Yep. Like
Yep.
the worst place to be is the stock market. Like get out, sell it. It feels so bad. I know.
Yeah.
But you got to have the courage to manage risk. That's really what it comes down to. Because when the market's down 10%, what's your portfolio doing? Like if the market's down 10%, my portfolio is probably down 1%. And I also have hedges that might be offsetting that. So that's why I can sit through a lot of this garbage that it's like, if we get a pullback, I know it's going to sound nasty. It's going to feel nasty, but I don't know if it, I mean, look at last year's July to August. It was over in less than 30 days.
Yep.
Like July 15th to August 15th, the market had already bottomed and it was ripping higher. And we had like a 10 or 12% rally off those lows within like 2 weeks. It's
Yeah.
just, it's so, and honestly, I think that these cycles will continue to be faster. Like this V bottom is like the biggest recovery we've ever had. This is the biggest vol crush we've ever had. It's like these cycles will probably get faster. And so I don't think like a prolonged 2008 or even the 2001 crash to like the 2008, like a 6 or 7 year like sideways range. And then we took 6 years to get out of the financial crisis lows. Once we bottomed in 2009, it was like 2013 before we hit highs again. I think those are a fraction of that time, which is why since 2018's Volmageddon event, 2019, 2020, all those were like literally over within what, 3 months,
Yep,
2 months,
very
6
quick.
months. I mean, from the 2022 high, this would be the S&P rolled over. It was January 2022. That high took until early 2024, but we had already gone down 30+%. We already started to make that Q4 trough, and we started to rip up where it was a pretty easy buy in Q4 2022 that started the run. And then we had 2 big bull market, like broad market rallies in 2023 that led us to a 20+% year. Anyway, none of it's easy, but
Yep.
I think if we go back to like, what's the main like lesson or takeaway today is I think we have a slowish July and there is some room for some volatility. I think getting at a sub 16 VIX right now, it shows that we're likely going to have some type of volatility spike ahead.
I agree.
I can't put a
Look at that,
perfect
15.85 now.
I know. I can't put a perfect pin on it, but it's like I would say that I'd be shocked to see the market not give us some type of pause or pullback that's meaningful by like September. Like
I'm gonna have to go look at some more. If we keep going down on the VIX, I'll have to look at selling some more calls on stuff. Just getting a little bit more protective. Anyways, Chris, you've been on all day today. I've been on all day today, so I'm gonna kick us both off here in just a second. Thanks for hanging out. Also, have to say, great shirt today, by the way. Very cool shirt. I got to get one like that.
Thank you kindly. Let me know, dude. I got a discount for you.
Yeah, that's awesome.
Right.
Anyways, guys, if you want to check out Chris Pulver, we'll drop the YouTube channel that he's got here in the chat. Boom, there it is. Check him out on YouTube. It's at Chris Pulver Trading. Also, quick plug to end out here. If you want to see the trading signals being sent by Chris and myself, both are available on our website, a1trading.com. Or if you have questions about that specifically, we'll drop a link here in the chat where you can speak directly to our support team about getting set up with the Pulver Alert service or our VIP membership, where you can see all trade signals being shared by our team. We share insights on every trade we're taking. If you want to learn, Chris just mentioned the idea of potentially seeing the market go down by 10% and still holding on to a minimal drawdown relationally to that. You can find out more about how he does all that stuff through options with the Pulver Alert service. So all that said, thank you guys very much for tuning in. Information on that is linked in the chat and in the description. Chris, thanks for coming on, man. We'll see you next time.
Thanks, Dick. See you.
See you guys.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.